Right. So this is your pre-scene analysis, and this is a very longer session. Why I say longer? So in a way, it's very good because in one session after my session, Dasun will take you through the financial reporting part. So from now to next 1 hour, right, you will see the amount of learning that you are going to refresh and apply case study learning. So without further ado, let me straight away start. And especially, I am targeting 1 hour. And during this 1 hour, I want you to make notes about very important points from the case study that you can really prepare for the examination. At the same time, you will also learn during this session many areas that you have to now go back and refresh your knowledge when you are preparing for the examination. So now I am not going to read para by para case study and waste your time in that sense, because I am sure all of you have read it and many lecturers would have read it with you. So now our task is actually to analyze the area that I am going to cover, corporate governance, right? That is not only corporate governance. As you know, for this, there is a segment called corporate governance and non-financial reporting, adding together 15% of your syllabus. And what is new there is that SLFRS sustainability standards that will be tested from this exam. Therefore, in this session, I will give some coverage to that as well. And then the other part is risk of material misstatement. So what are the areas from this case study that we can navigate? So those are the areas that we are going to cover. So I will give this one-page summary of the case study in particular. From a corporate governance angle, this slide will be very useful. If you look at the way they started the business, Roshan has the entrepreneur who is the chairman and his friend Kamal, managing director. So you can see at a glance, there is a separation between chairman and the CEO. Instead of CEO, it is a managing director, very similar to CEO's role. But we can't say that chairman is independent because he is involved in the business. If you look at the corporate governance code, if you straight apply corporate governance requirement, the recommendation is to split CEO and chair, because the corporate governance code specifically says if there is no split, majority of the board should be non-executive. So one thing, this case study, I mean, there are a lot of non-executives, as you can see. Let's see how the balance board members, now this is spouse, join as a non-executive directors. As the business expands to the other areas like warehouse and transportation, you can see at a point in 2008, they realized the need to appoint independent non-executive directors. That's really great, because the whole idea of corporate governance again, now I won't ask you, I am again reminding you, because from now onwards, you will refresh a lot of examinable topics. So please have a blank piece of paper with you and write these points and ask whether you know this. So one question that I want to ask you, which is in the syllabus, the essence of corporate governance is to bring, non-executive directors are called guardians of corporate governance. In whatever committee you talk, there are non-executives and independent non-executives. Do you know why? So if examiner asks you, or if you want to explain the role of non-executive directors, you should be able to explain these four, right, which is also in the study text. If you don't know these things, that means you haven't properly learned corporate governance, because corporate governance is not to read corporate governance code only, but to apply or criticize or to evaluate in a given case study how the board structure, the functions of the board, etc. Now, why these people are added? If you look at Tenika, right, with a logistic expertise, again, Nimalka, logistic expertise, and Salia, marketing expertise, they bring, my question to you, I will ask, why non-executive directors, right? Why non-executive directors? So remember these four, they play strategy role, double S, scrutiny role, risk role, and people role. Especially from a strategy perspective, when you have non-executives, they bring that outside perspective. right? Expertise, which is important in strategy formulation process. And then the scrutiny, specifically the non-executives can look at the executive activities from an independence lens and contribute through professional judgment. Especially if you look at the committees like audit committee, the scrutiny role is very important, and the risk role is where executives may be risk blind, they make decisions, but when it comes to non-executives, they will look at risk critically, and the people role. Now, these are all in study text, but very, very important fundamentals in corporate governance, which you need to remember. And that is probably the reason. Actually, they are not just non-executives, but independent non-executive directors. Then, when the IPO came, you can see they wanted to further expand to different businesses, right? Especially they acquired their own transport fleet. And another addition to board is Ajanta, the Silva, right? So 8% shares, we can say, is now independent, and it specifically says executive director, and he holds directorship in several other companies, right? So now with this addition, you can see the number of, if you look at a glance, the board structure, right? So these 8 directors, you can see out of that, there are 4 non-executives, right? So 1, 2, 3, and this wife role also non-executives, right? So, but then you can still question that because there is no independent chair, the majority of the board should be non-executive in that sense. So that's the point that you can immediately note. The other important thing, when it comes to these non-executive directors, as we go along, we will discuss, certain committees, but this is at the start. You need to have an understanding about the board structure. But one more thing I want to ask, remember another topic which has not been tested in the exam, but in your syllabus is women on board, right? So what do you know about this? Refresh all of this topic. Another topic which is relevant for the exam, please write board diversity. Now, these are very important corporate governance topic. Now, are you satisfied about the diversity of this company's board of directors? How are you going to comment, and why that diversity is important? So if there is an exam question like that, are you able to answer? So now, if you look at some of these people, there is one diversity is gender diversity. We have women on board. So why women on board? Again, there are multiple reasons. One is the education wise, the knowledge. Right now, the agenda for the women on board is the knowledge pool, wider knowledge pool in whatever qualification. If you look at their female dominance is there, and then they understand, the research shows the market better than men, perhaps, right? Now, this is not just what I say. These are studies done on women on board, right? Then third, they are more conscientious. They prepare much better when it comes to board meeting. And they are also good in terms of ethical aspect. Now, these are all areas that you need to go through, right? When you read the study pack, you need to understand this is another topic. And then board diversity in this case study, are you happy? So, okay, there is a gender balance in the board. And also there are multiple functions like logistic is their core business. Is good to have more logistic people, but there are also marketing people, right? And there is a qualified finance director. So there is kind of diversity. So why that diversity is important? Again, if there is an exam question, you should be able to explain. Diverse board bring, right, more perspective. They bring also expertise with them, which is important for strategy making process like we discussed. And also when there is board diversity, remember you can break group think. Group think means if all are chartered accountants, they will all think in terms of numbers and financial aspect. But if you bring different members, there will be different perspective. That's called group think. You can break group think through diversity, proper board diversity. And then in addition, when you have people representing different areas, you can it improve company's reputation, and then company can be viewed as more of socially responsible, corporate responsible corporate, So those topics I am just reminding you, right? Board diversity, the non-executive director's role, etc. Right? Those are not there in the open book, but your knowledge. Now I am also going to ask several questions in this case study. What are the possible exam questions as we move on? So this is just the intro. And then, are you ready for the exam with the changes? There is a revised corporate governance code. What are some of the salient changes? And also the listing rules were revised. So it's good for you to know those things. I am not going to cover all of that, but some emphasis. So when it comes to this company, again, you may ask, so in listing rule, remember this is a listed company, right? So are you satisfied that at least there should be 5 directors? Yes. And then minimum number of independent directors 2. Here there are 3. That's fine. But when it comes to CA code, 3 non-executive directors. And out of that, case study right now says independence, but examiner might give you more information to analyze whether independence is there. If so, there is one more change that you need to see in independence criteria also. There is one change when you go through the book. Especially those days, some companies justify, although independence criteria is violated, sometimes still they consider this director is independent. Now the court says you can't say that. The only case you justify is the 9-year rule, right? In case of a director, just say 10th year, but you may have a case to say why this director can still function as an independent director. Now, page number 5. I am highlighting some facts here. Now, that's why I'm saying this is every minute in this lecture is so important. You are going to learn something directly linked to the exam and also linked to your case study. Now, in page number 5, why I am highlighting this part? Here it says, okay, why I am highlighting? What does it mean to you? I am giving you the topic also to think. Control environment, but it's FRF. You can guess that. FRF means what? Now read this, page number 5, paragraph 5. It says company has fostered a culture of quick decision making, right? Quick decisions. Department heads are empowered to make decisions to enhance responsive and agility supported by clear defined SOP to prevent human error. So in a way, it is good that, processes are documented. At the same time, they are saying that there is a culture of quick decision making, right? Agility. And also, I'm connecting this information to the last paragraph where it says the company promotes autonomy. So more independently working, individual contributions are valued, right? And then at the end, it says, this leads to high level of motivation and expect performance, but is also reflected in companies' evaluation process, annual promotion, increment, and year-end bonuses. So why this information important? It gives you some information about FRF. Remember, now, if you look at this company's results, see, they are really struggling. The revenue, not only this company, any company in freight industry, you will see this. There is a drop in revenue, profit, everything, because they are under pressure. Now, when they are under pressure, specifically, these paragraph indicate they are kind of what? Very much target-driven culture. When you are target-driven, it creates pressure. Pressure to achieve target, somehow achieve. And also it creates incentivization, because if I hit this target, I am going to get my bonus. And remember, this pressure or incentive, as you remember, this fraud triangle is a famous topic tested many times in the exam. Fraud risk factors. The incentivization means, is there a reason for me to manipulate something? Yes. So if revenue is going to be higher, I'm going to get paid in terms of commission. And also when there is a pressure, right? So that's where incentive pressure comes. And then opportunity, for example, weak internal control. Now in this case study also, there is a discussion about lack of segregation of duties, opportunity for fraud, right? Conflict of interest, things like that. And then attitude or rationalization is that top managers, they do bad things and say these are good, right? Attitude or rationalization. This is a quick recap of fraud risk assessment, which is a part of business risk. Business risk, risk of material misstatement, part of that is fraud risk. This is fraud risk. So these are very, very important. So now this is the point. While their ISOP is a sound indicator of a good control environment, but the fraud risk factors are this: target-driven culture, incentive pressure, especially when the external environment is not good, and it is the case. And the other big point is that when they say that there is a freedom, quick decision, agile, it also may mean the next fraud risk factor, which is very, very important, please write: management override of control. Management can bypass control and manipulate. Obviously, that would have happened in this case study. When you read it at a point, it says accounts are inaccurate, right? There are conflict of interest, fraudulent things, unauthorized transactions, because most probably management override of control is there. So therefore, if the examiner asks you to comment on risk of material misstatement, don't forget to talk about the risk of management override of control. Then moving on to page number 6, you can see what I have highlighted, and I want you to look at your case study and see whether you have noted these points. Now, why I'm highlighting these points here, as a part of the routine process, they review the current policy process structure to identify barriers to change. And if there are any barriers in the policies, they do adjustments, right? And again, this is the indication of those management override of control, MOC, which I spoke, right? Then this part is what? In logistics sector, company has implemented cutting edge technology, AI, Internet of Things, blockchain to optimize their supply chain, delivery services. AI power algorithms are used to predict the demand. All good. But there is a risk. What is the risk? The implementation of this technology helps in inventory management, everything. But what is the impact of the risk assessment? And that is prominently given in this case study. What is the risk? The cyber security, right? So higher cyber security risk due to why there is a higher cyber security risk in this case study. Remember, it's not for every company, because this case study's business model is such they are extensively exposed to the external world, many devices, many platforms, right? And through AI, the more connectivity you have to the external world, right, there will be, higher risk. So that part we will discuss. So this is very important. Now, if I ask you this question, right, now students, you can comment. If examiner asks this question from you, what is your answer? Please write down. Now, at a point somewhere in the case study, there is a cyber attack, cyber risk they are talking, right? Now, if they ask this question, comment on the board oversight role on cyber risk management. It is in the syllabus, right? It's a part of risk management, part of corporate governance. So what are you going to write? You have to write something, no? Okay, I'll come to that question. So those are the things you have to be very sensitive when you read the case study, right? So I'll cover that cybersecurity risk in a while. Now, this is the most important part. Your attention is very much needed. Page number 7 is a key page because specifically is on corporate governance. Under the banner of corporate governance, they talk about you don't need to do a lot of calculation, all are given, right? So the revenue dropped by 22%, right? Revenue, gross profit, net profit, everything, right? You can see when you look at the accounts, how adverse they are for short-term financial performance. Not only that, it's not only short-term financial health, but it also about the strategic direction. Now, if I ask you this question, what are the 4 functions of the board? What are the 4 functions of the board? Are these companies' board of directors are actively managing those 4 functions? I can break these 4 functions to 2 as performance function and conformance function. This is in the syllabus, learning outcome. Right? So strategy is part of that. So again, I will cover that part because if you don't know these things, you haven't properly learned corporate governance. Remember, students, you can be the prize winner in this tough subject. You can be very happy in the journey of becoming chartered accountant if you are the prize winner for ABR. The only way to get the prize is not only to do consolidation and the accounting standard. By the time you do all of that, and you will see, wow, time goes. I have only 5-10 minutes. The Instead, a wise student will know that very easily this section will help you to score. And if you have a decent marks in financial reporting, let us say about 40, 50, and you get another 30, you are the prize winner. Whereas what generally happens, most of the students ignore these sections and they go and, spend a lot of time, and sometimes they don't get 50 also. That's where the proper balance is very important, because certainly about 40 marks you can easily approach. Take ethics question, so easy because every past paper similar questions, right? Now one student is asking about, they have the old ethics books. I mean, you can buy the new ethics books, but what is the incremental value that you can add from that, even if you read the entire book? So remember, students, here is something to deal with confidence. Without any book, confidently can you write? If the book is needed, now cyber security, what I ask you is specifically in this book. And imagine you haven't read that page even before the exam, you don't know it is in the book. And that is the biggest problem. If something in the book, you must know very quickly to get that and write. But don't expect copy and paste. That is deadly. But obviously, when there is a question from the book, you can bring that in and connect to the case study. That's very, very important, right? So in any case, if you need more explanation, because today lecture I had to restrict to 1 hour, because after mine, the other part is connected, right? In case you think that you need to learn more, let me know. We will probably see whether there is another discussion. So now, if you look at the balance information, if you ask me from governance and risk perspective, most important paragraph in the case study is this. Most important, no? Most important paragraph is this. Sorry. What is that paragraph? During the annual audit process, external auditor raised concerns over discrepancy in the company's financial statement, which led to inaccuracies in reported not only earning expenses. These shortcomings significantly eroded stakeholders, see, not shareholders, stakeholders, maybe bankers, right, and highlighted the effectiveness of, right? This is a keyword, financial oversight. Now I'm asking you, you can use the chat and comment. Who is supposed to have the oversight responsibility on financial reporting? While it is the board, usually board delegates that to which committee? Audit committee. Now this case study says they have audit committee of independent members, but are they sleeping? For this to happen, something radically wrong. Now, what are the possible reasons and what are your recommendations? Did you think about it? Right? What are the internal control failures that contributed to this, that affect the integrity of financial statements? All of these are there in the syllabus as yellow. So examiner can ask anyway, any forms, different questions, and I have put several questions I'll show you in a subsequent slide, right? Then look at this paragraph. Here is where they talk about the board composition and structure. If you look at the last, you see in the corporate governance, the last exam paper, latest paper, if you take, it talks about good things about core. Normally what happens, past paper, we see some weaknesses, right? We write, okay, this governance, this is not there, this is not there. But in the last exam, the expectation was to talk about positive things. There is a board balance, there is a board diversity. Likewise, when you read this paragraph, it's good. The composition, actually board is good, right? Now there's another comment from a student, in this case, chairman and MD, two separate person, even though they're friends. In that case, majority non-executive. No, the question is this, right? The whether it is true or not, you see, if you go to the corporate governance code, what it says, chairman has to be independent, right? In case chairman is not independent. Now, what do you mean by independent, right? If you are engaging in business, you are not independent. Now, that is where you need to have majority of the board, non-executive directors, right? So my point is on whether the chairman is independent. So what the corporate governance code says, in case CEO and chairman are the same. Oh, chairman is not independent. Go and highlight that word. Right? Those are very sensitive things, but you need to be aware. The composition and structure of the present board of directors ensure, see, diverse. We spoke about board diversity, skill mix of executives and non-executive directors. Board oversee company, see, strategic direction, performance. I ask you 4 functions of the board. What are the 4 functions? Some board functions deals with future, right? Future and external. So what is future and external is strategy role of the board. Strategy formulation, looking ahead, what we are going to do now. The freight business is not doing well. Look at the external environment, right? And look at the future and then think about strategy. So strategy is one role like that. What are the other role? The board role in policy making, right? And then the board role, main role of the board is to challenge the management and monitor what your management team is doing through various committees. That is called monitoring role. The other role is to be very transparent and give the right information to shareholders and stakeholders. That is called accountability. Those are the 4 roles: strategy role, policy making role, and then monitoring the management. And the 4th one is accountability. I'll show you that in a diagram here. Those are very important specific LOs. Remember, what examiner can test is only LO, learning outcome. The questions are based on LOs. For that part, now there is LO, go and read. The functions explain or evaluate the functions of the board. There is LO, but you don't know what those functions are. That means you have read a lot of things, but it is not in this book also, right? But it is in the study text. So you need to know those things, right? So this part is about, so strategy area of the board is discussed. And performance, right? And also they are responsible for effective risk management and internal control. Now, this is the monitoring part, monitoring role of the board, right? But now we can see they have failed here because case study itself says their risk management is not good. Their regulatory compliance is not good. So I'll show you that part, right? So internal controls are failing. It also monitors compliance with legal and regulatory compliance. So this is again monitoring role. And then the company has independent. Now this is where there is audit committee, but we have a question as to what they are doing. Company maintains open and transparent communication. The last is very, very important because I'm going to talk a little more about it. ESG, IFRS sustainability standards, right? So that can be tested as the first thing, you know, the very first time in this paper because it's applicable. Now, I'm asking you a question. Very important question. Now, what is, by reading this paragraph, that their revenue has significantly dropped, their profitability significantly dropped, what is the risk if examiner decide to test this LO, right? What is that LO? Evaluate how significant business risk, because this is a business risk, how it is going to impact your financial statements, including fraud risk factors. See, now this is a good LO that can be tested as a part of this paper. What is your answer? What is your answer? First of all, understand, I'm sure in next session also you will go into a lot of detail of numbers. But one big thing, look at any of the companies in Sri Lanka, Aitken Spence, Haley's, or Freight, when it comes to Freight, Explore Lanka, all of these companies, you can see there is a drop in revenue, profitability. Why? That part of the risk is coming from the business risk, especially geopolitical risk, you know, with the current problem, the geopolitical issues with these regions, Red Sea issue, how vessels were interrupted, right? And also there is a decline in the global merchandise, global market when it comes to merchandising. That has brought the business down. I'm giving you an example here from Aitken Spence, how the global, see the 60 to 70% freight drop, right? And then 1.2% decline in the merchandise. What does it mean to you, right? What does it mean to you? Remember the point that I mentioned earlier. You can say there is a high risk if examiner asks to comment on this, right? Evaluate the business risk. The main business risk you may talk about is adverse. Now, this is the main business risk. The business risk where there is a significant drop in the freight rates and the decline in the merchandise trade has resulted in drop in companies' revenue and profitability. How it can impact the financial statement, that could create what? Incentive, or more than the incentive, the word is pressure, right? That could create pressure to manipulate, and that is a fraud risk factors. So that the specifically the revenue recognition is area, when it comes to risk of misstatement, we have something called rebuttable presumption. Rebuttable presumption means in every company this is there until you prove it is not there. So there is a rebuttable presumption that revenue recognition can be overstated, especially in this company, given the higher business risk and the volume has dropped. And the fact that the most of the managers, there is an incentive driven culture that I explained to you earlier, the chances that revenue can be overstated is high. Number one. Number two, similarly, there is a chance where expenses and liabilities can be overstated, right? Expenses can be understated, liabilities can be understated again because of the this fraud risk factor as well as management override of control. That's where the fraud prominently comes in. So, but remember, you have to connect that answer to the business risk. Huh? So now what you should do is to write an answer. I will show you several questions like that where you should write the answer. Now, this is how, now let's see how do you write these answers. Now I'm going to the accounts. Now see, you can see when you do, I'm sure you'd have done your maths, the basic ratios of everything. We can see the revenue drop, cost of sale, the GP, how it is dropping from last year, right? And overall profit margin drop. And then when it comes to balance sheet, I have highlighted some assets in yellow specifically. Why? Remember, ROM, risk of material misstatement means what? It is coming from one business risk, one source, and then it is also coming from complexity, and that is where the inherent risk is created, IR. When the IR inherent risk is high, there is naturally a possibility for higher risk. So generally, these areas, right? Now I have already written, if you want to write, now my challenge to you students, if examiner asks, please write this question. Examiner asks in this way. In case of EPL, evaluate 4 business risks that could potentially affect financial statements. Put it in that way. Now, can you write the answer? Or else examiner will directly give you, evaluate 4 risk of misstatement from the case study. Now, I have listed it, but you need to write a sentence properly to explain this risk. Revenue recognition. I am sure, again, in the next lecture, we'll learn a lot of things about freight forwarding, how SLFR is 15, the complication, because there can be multiple performance obligation. You need to split it because sometimes you take the goods and keep in your warehouse, and for that you charge warehousing fee. That can be a separate performance obligation, and then when you ship it, you have to separately identify. And what point you identify? Is it a point in time? Right? And then sometimes these rates are variable, there are demurrage charges. So then variable component comes in. For risk of misstatement, all of this is one word. You can know accounting standard, but know the risk language. The risk language is because of the complexity in revenue recognition involved in multiple components, for example, therefore there is a higher inherent risk of what? Errors, overstatement. Overstatement will specifically come, please write this word, due to what? Management bias. Especially when there are judgment, there is a management bias. Management bias will automatically come when there is a fraud risk. Again, management bias is a source. Now, these are critical words that you may use. When you use these words, the examiner knows that you are a student who knows the subject. What are the critical words we spoke? Right? We spoke about rebuttable presumption. We spoke about management override of control, and now management bias, right? So That accounting standard I'm converting to a risk answer. Risk answer is this. I'm writing one sentence. You can write it. Given the complexity in revenue recognition involved in, you can give example like multiple component, variable charges, there is a high risk of errors, including overstatement due to management bias, full stop. I wrote one sentence. I am writing a second sentence. Further, there is a risk of overstatement of revenue due to management pressure to achieve targets. So now I have written two sentences and I got, say, 3 marks. That's how you write answers. Then I might now, if examiner wants more, is you can talk about intangible assets, right? There may be a chance why I am writing this answer, because usually these any areas which involve estimations, there is something called, what is the word again? Estimation, estimation uncertainty. Again, with the management bias, this can be, overstated. I mean, impairment may be undercharged. So again, recognition of right to use inherent risk may be high because of the complexity we need to look at. Now, for example, they would have constructed warehouses in a leased places. Then you need to apply the standard, which involve always use assumption and judgment. Therefore, the risk is high. Then we know this investment is making losses. This may be impaired. And when the company is not doing well, the deferred tax assets may not be recoverable. And also there may be chances of impairment receivable. The most prominent risk is this management overhead of control, which we spoke. So those are the risk of misstatement. Remember, one question that examiner can target is this area, risk of material misstatement. Now, this part, this I already spoke to you. Internal control, however, now this is second most critical paragraph where they say specifically in this company, notable weaknesses, right? Particularly in risk management, fraud prevention, and regulatory compliance, right? A key issue was the insufficient segregation of duties. Now you see in this company, risk management, they are not happy. Now again, in corporate governance code, there is a section now which committee should do risk management. If there is exam question, that now they are actively thinking to revamp risk management and evaluating whether audit committee can take that. Are you agreeable? Can audit committee manage risk? Yes, even the listing rule says if you want, you can do that, but you should know that, right? It is there. I'll show you in this presentation. So, risk management, fraud prevention, and regulatory compliance. A key issue was the insufficient segregation of duty, SOD, which created opportunity. See the word opportunity, fraud, risk factor. Opportunity for conflict of interest and unauthorized transaction is a possibly fraud. And not only that, cyber security data breaches, which is going to result in data breaches of customer information, expose the company to potential legal and financial liability. Remember, if you are in Europe, you know this act. GDPR, percentage of revenue, you have to find this percentage of revenue, global data protection requirement. Now here multiple issues are mentioned. What are your recommendations to improve internal control to address the current deficiency? What is the answer? Can you write? Can you comment? If this type of a question comes, what is your answer? Students, what can be your answer? What are your recommendations? See, first of all, you can apply COSO framework and evaluate what is weak in this case study. Secondly, there is a new LO introduced to your syllabus about 2 years before when the hours changed. That is to know how internal control responsibilities can be structured. Say 3 lines model, for example, right? So if you look at the COSO framework, 17 compound. Remember, this is new knowledge, right? This is not new, but for you, some of you, this is new, right? There are 17 principles in COSO framework. And if you look at it, you should be able to apply this framework to your case study. Look at the last past paper. Examiner wants to analyze the entire area using COSO framework. Now, my question is for you not to memorize COSO framework, but how do you apply and say, look here, these are the areas this company is failing. For example, What is your comment on the control environment? Now we can see this company has a code of ethics. Good. And then there are independent board of directors available. There are 3 non-executive directors, audit committee, everything. Structures, lines, authority may be clear in terms of SOPs that are there. Possibly we are not very sure how they are attracting good people or not. People are held accountable for internal control. There is a serious question with these issues that are happening. So there is, even in control environment, there may be gaps, right? Especially remember, the biggest gap which we can see is management override of control. So although there are independent board oversight, this is questionable. That is why financial statements are inaccurate. So this is questionable. That is how I am criticizing our control environment, because this independence oversight role is not adequate. No point of talking theory if you don't apply to the case study, right? Then I am also not happy with their risk assessment process. Specifically, they have failed to address fraud risks. These unauthorized transactions are happening, and also they have failed to deal with cyber risk. Data breach has happened. Therefore, probably risk management is not properly working in certain areas. And when it comes to cyber risk, specifically information, IT controls are critical. What are the IT controls? The cyber security risk management, how it has worked? It may have not worked. And most importantly, the last piece of course is that, are you happy with the monitoring process? Usually the monitoring is about internal audit. How frequently are they evaluating internal control as a separate exercise, right? Or it is an ongoing process. Whether weaknesses are reported to board? Probably no. Until external auditor finds, no one has identified. So then where are the internal auditors of this company? Now this is how you apply also to the case study. We can write maybe half a page for 10 marks, right? So like that you should be able to answer. The other thing, other modern way of structuring internal control is to align to 3 lines model. This is again, these are included in material with the syllabus change. You know, there is a supplementary guide with these changes. Now, 3 lines model, if you look at, first of all, the governance body's role. Now here, for example, audit committee's role. Then when it comes to management, look at, this is a freight management company. If you look at a warehouse in charge, he has to ensure the safety of the goods, the physical availability of the goods, because you do warehouse operation also, I took as an example. So that warehouse manager is called the first line. He's responsible. Now, sometimes in this warehouse, the stock counts are not happening, the items are missing, the customer is complaining. So there is no checking. There is a second line, maybe a compliance person checking that process is happening. And usually risk management comes under second line. Then third line is the only line which is directly reporting to audit committee or a board, that is internal audit. So the 3 line model is also helpful in structuring internal controls, right? Yes, I will share the slides with you. These are prepared for you, right? But remember, there is a lot of, if you want to learn from this, I'm showing you exam type question, go and answer, right? And with this lecture, you must know there are very sensitive knowledge component in the syllabus you must learn, right? So that's what is important. Now, so my question to you, cyber risk, if this is tested, explain the board oversight role on cyber risk. You answer, the new code of corporate governance code is updated with cyber risk. The first thing is the board has to ensure that there is a cyber risk management process in the company and a policy and a person. One is a risk management process, policy, and the person. Person's name is Chief Information Security Officer. Then that policy has to say these control measures should come. As you know, traditionally we know for cyber risk there is, you know, if external attacks comes, we have firewall. Now those are traditional now. You have now things like SASE, right? So firewall protect only this location, but if you look at SASE type of a security measure with the increase in cyber threat, it will look at the entire network and protect you, right? Even in your book, there are answers that you can pick. So look at these answers. Now what I explained to you, page number 42. The board should have a process to identify how the business model and IT devices can be exposed. Now, in this case study, you can specifically write the business model of this company is such that they are very much exposed due to the extensive use of AI and other IoTs, many connectivity, cyber risk is high. So from where the cyber risk comes, sources, one is end user can compromise. Whatever security you have, for example, phishing attack, you go and click that link and done. Then what will happen that external things can pivot to your data center and it can destroy. Or externally compromise. So how external devices, probably now you are connected to a supply or custom portal through that attacker will come, or a third party that you are dealing with, or physically they will attack. Now then, this is what I mentioned to you, Sassy. Then if you look at in terms of answers, right? Oh, this is the answer, cyber risk. Huh? So one is, well, first one we discussed. The second one is there should be a CIO, Chief Information Security Officer. Third one, you need to have a policy and process that specifically things like incident reporting system, right? Vendor management system, disaster recovery plan. If the system is down, how soon you will recover, right? And cybersecurity insurance. These are part of your overall cyber risk management process. Good thing is open book, but you must know before the exam this is there in the book. Then whether board is allocating sufficient time to discuss cyber risk, right? And then finally, board should ensure effectiveness of cybersecurity risk management through periodic audit, right? Whether they are getting, I'm definitely sure this company internal auditor may not check, but at least externally whether they will get cyber experts and cover. And also your book schedule law has things board of directors should do on cyber risk. Then page number 42 and 43, please note that. And finally, not finally, so now when it comes to corporate governance question, I have covered some of this already. Got stop. Give me a minute, it got stuck. Right. So now we are coming to page number 10. Now, so far what I have done, I am just showing you most sensitive areas in the case study, and I am ending my lecture with questions. Please note those questions, right? As I told you, I'll share. Now, the most important part that you need to be aware is ESG or sustainability reporting. IFRS S1 and S2. Now, they talk about they want to reduce their emission, right? Now they want to reduce their carbon footprint. So they are talking about carbon emissions. See, how about climate risk reporting? Now let's say if they are in top 100 company from 2025, IFRS S1 and S2 is applicable, right? But they can use the proportionality principle. But what is proportionality principle? You must know that. What is transitional relief? You must know that. What is sustainability related risk and opportunities? You must know that. I'm sure with the time, although I wanted to give a good coverage to that, maybe that is in this lecture I may not be able to do. Probably we may have to cover. If you want that in a little detail, I can do a session. but I will cover what is in the case study for sure, right? Now the way, okay, let me go to the exam type question now. How do you answer these type of questions? Evaluate the effectiveness of the board in terms of prime board responsibility. How do you answer this question? Now see, I am all connecting to LOs. Prime board responsibilities means the board of directors responsibility in terms of what? What we discuss. Entrepreneur, if you go to this book, again, page A1 talks about, I mean, the principle A1 talks about board of directors role. It says entrepreneurial leadership, right, within a framework of prudent and effective risk management, how board is considering the strategy, whether senior management team is competent, whether CEO succession plan is there, how they are monitoring performance, compliance with the laws. Now all of that we can put in a nice framework. This is what I explained to you. This is in page number 820 of study text. I told you the board role, future focus and outward looking is strategy role, and then they have to work within a policy framework, and this is called what? Performance role. And when it comes to internal, right, and present and past role, day-to-day role is to monitor and supervise the management and then give right information to shareholders. And this is a conformance role. I already covered this, but read this page and be able to answer functions of the board. Right now, this is same how this company has managed the functions. We can probably see they are kind of not doing well even in their strategy as well as performance. If you are to criticize this, you can comment, right? And then I think these things I explained to you, right? The listing rule, the changes. I think where I want to draw attention is specifically not to this, but audit committee, right? Now this is especially this company's audit committee, right? Are you happy with the role of the audit committee? Now this one, we are not happy with, if this question comes, evaluate the function of the board committee in ensuring the integrity of financial reporting process. Which committee? It is audit committee, and audit committee has failed probably to exercise that role, right? And evaluate the role of audit committee in strengthening the control environment. If there is a question like this, what are you going to write? So when it comes to most of the areas of audit committee, it appears that, for example, cyber security risks, right? Cyber risk, internal control, financial statements, all of this. And there is no talk about internal audit. All these areas has failed. Another question, if they ask the external auditor and audit committee connection, advise the main areas of interaction between this committee. Now, the case study also talks about the management letter sending thing, right? So these are the questions based on my discussion. Actually, you can try developing some answers, right? And most importantly, I wanted to show you in the new listing rule, just be aware there are 13 areas which is relevant to audit committee regarding 3 topics: financial reporting, risk management, internal and external audit. And specifically, it says risk management, if they want, they can even give it to audit committee or a risk committee, or it can be taken by the entire board. So the last thing that I want to remind you, sustainability reporting, which is very, very important, right? Now, exam, I mean, this pre-scene has limited information talking about sustainability and emission, but what can be potentially tested in the exam is what is the board role in sustainability related financial information, SRRO. First of all, you must know SRRO means, right? Any sustainability related risk, let us say now there is a flood or water is not available. If that is going to affect future prospects, 3 things. What are the 3 things, right? 3 things are cash flow, access to finance, cost of capital. If these 3 are going to be affected, it's called SRRO, right? Now, those SRRO, board has a responsibility. First of all, board must know this subject, especially when it comes to S2 standard, it's about climate risk, right? So climate risk we can divide into transitional risk and physical risk. Physical risk means there are chronic risk and acute risk, right? So chronic risk is long-term change in the weather pattern, suddenly what is happening in this season, right? Acute means suddenly there is a flood in Spain, right? I have done a full session actually that's freely available. You can watch on this, but if you have, I think case study does not specifically go into a lot of detail, but please make a note. Please make a note. You must know transitional provision and proportionality principle, because IFRS S1 and S2 seems to be very complex, because when it comes to climate risk, you have to do scenario planning and analysis. But the critical point is, please write proportionality principle allows companies to use, please write what? Available data, right? Without spending a lot of effort, right? So this is the word. And then whenever there is a quantification, you can actually, I'll come to this. This is what is very, very important, right? Proportionality principle is this. Proportionality mechanism means when it comes to complex areas like climate related scenario analysis, you can use these two headers. You have to remember information limited to what is reasonable and supportable without undue cost or effort. And without quantifying, you can do it qualitatively based on the skill that you have. That's called proportionality principle. So unfortunately, right, I can talk another 1 hour on this topic, but actually it's not a part of pre-scene discussion. But certainly I will do some coverage with this. And if you have any other questions, can you share some thoughts in the chat in terms of what are the areas that you need to me to touch before I hand over the session. Are those three independent directors are still independent in relation to 9-year rule? Yeah, so I think now if you look at, have they given the date by which those three directors are appointed? No, the dates and informations have not been given, right? So then what I mentioned to you about 9-year rule is uh, the 9 years is the only rule where a company can make a justification, right? Otherwise, it's not acceptable. Okay, let's see your comments. Yes, please, sir, especially recap on new changes to corporate governance. Okay, right. So I'm sure in respect of the case study per se, whatever slides I showed you, every paragraph we critically looked at, right? So this, information, how do you put that into this syllabus and see how that can be tested? That's where I listed several questions. And then, especially if you take as a summary, the corporate governance area examiner can test, especially audit committee, how they have failed, risk management they can test, cybersecurity risk management, and then, right, very good. Sorry, now we are talking about the years is given 2008 one student, yeah, then definitely 9-year rule applies, yeah. So that's a good observation because they have appointed in 2008. So 9-year rules apply. Right. So I will share, as I told you, the presentation, right? And so what I was talking, those are the examinable topic. The other very important topic, which I showed you with the balance sheet figures, is prepare answer for risk of misstatement, at least 3-4 areas. Then the next area is sustainability reporting, right? So I have done a lecture which is freely available to students in YouTube. You can go and check. And then if you need any other, case study specific areas in this, you can talk to Aruna, and then I can facilitate maybe another quick discussion, because I have promised this time to hand over. With that, Dasun will take over the balance part. So are there any other question before I wrap up? Right. Thanks for your comments. Thank you.
Hi everyone. Can you hear me?
Yes, we can hear. Yes.
Right. So what we're going to do now is actually to start the financial reporting aspect of the pre-scene analysis. Right. So I'm not going to go through the pre-scene as you have read that several times. So I have prepared the PowerPoint presentation. At the end of the session, I'll be sharing the PowerPoint presentation with you. Right. So during the session, if you have any questions, you can use the chat box to ask the question. I might answer at that time, or I might answer at the end of the session. That is not to disturb the flow of the session. Right. So with that note, let's start the session in terms of the pre-scene analysis. So there are four areas of this particular presentation, what I'm going to discuss. So about the company, right? Brief introduction about the important aspect in terms of the company relevant to the case study. Then we are deep diving in terms of the accounting standards, consolidation, and the analysis and the interpretation areas, which can be tested when it comes to the examination, right? Looking at the company, right, there are uh, two companies in this situation, right? So the information is given about two companies. The main company is actually Ecom Logistics PLC, ELP, so which has a number of business segments, right? So including freight forwarding, domestic transportation, warehousing, customs clearance, packaging, and moving with regard to the personal effects, personal items. So we look at these business areas in detail when it comes when we look at the application of SLFRS 15, the revenue recognition standard, how the revenue to be recognized under each of the business category. Thereafter, this particular entity was established in 1995 and it was listed in the Colombo Stock Exchange in 2015, which means this is a listed company, which means the applicable standards is the full SLFRSs, right? If you are a listed company, you must apply full SLFRSs in terms of the preparation of financial statements, right? Then if you look at the share capital, so you have 500 million shares in issue, number of shares, and the per value of a share is 10 rupees, and the total value of the share capital is 5,000 million or 5 billion, right? So if you look at the ownership structure, Roshan, who is the chairman of the company, is holding 30% currently, right? And Kamal, he's the managing director. He also holds 30% of the shares of the company. Then there's a executive director called Ajanta. He actually bought 8% of the ownership of the company and became an executive director, right? Public is holding remaining 32%. Actually, the public holding was 8 plus 32. Then Ajanta bought about 8%. Now Ajanta is holding 8% and public holding of the company is 32%. And if you look at this case study, this company, that is EPL, so made an investment, right? They made an investment. So that is actually EPL acquired 26% share capital of Ocean Shipping Line. So OSL in 2021. That means sometimes back, right? EPL bought 26% shareholding of OSL. So which means when it comes to consolidation, we'll discuss in detail. At the moment, most probably this has to be a associate of ELP, right? So then one important information there is, now once ELP acquired 26% shareholding of Ocean Shipping Line or OSL, so ELP might have been given the chance to appoint a board member for OSL. So what ELP might have done was ELP might have appointed Roshan. Actually, Roshan is one of the non-executive director of OSL. right? So the point what I wanted to mention is ELP has 26% stake in OSL, as well as ELP appointed one of the board member of OSL. So that's why I said that. So if you can appoint a board member of another company, so normally you believe that you have the significant influence over the other company because you can participate for the policy making process of that company, right? But the details about this particular investment we'll look at once we look at the consolidation area. Okay, right? These are the information given about ELP, Ecom Logistics PLC. And as I mentioned, you have been given information about another company. That is what I have mentioned earlier. That is where ELP has made a 26% investment, OSL. So if you look at the details that is given in the pre-scene with regard to OSL is, so the name of the company is Ocean Shipping Line Private Limited, OSL, which is a private limited company, right? So the main business is non-vessel operating common carrier, NVOCC, right? Yet again, we look at what this is, what this business in very, simple language, right? Because this particular pre-scene is with regard to the logistic industry. So the examiner is not expecting the students to have a detailed technical knowledge about the industry, right? Having a simple knowledge is enough. So that's why about these business areas, I'll give you a brief when I'm going through the this particular area in terms of the revenue recognition. At that time, I'll give you a simple explanation about what these businesses are. Right. So this particular company performs services as a carrier, but the company does not own any vessels. Right. Then with regard to the timeline, what it was given is this particular company was acquired by ELP, right, in 2021. It was mentioned earlier. So OSL was acquired by ELP in 2021. Then if you look at the share capital of this particular company, is 1,250 million is the value of the share capital. And if you look at the ownership structure of OSL, 26% of the shares are held by ECL. That is 26% of the shares are held by ELP, right? It has to be ELP. So that's what I have mentioned earlier. Then this is very important information, that is, so the company name has to be ELP, right? Here it has to be ELP, not ECL. Sorry for that. Now, if you look at the shareholding of OSL, one of the other important information is Ajanta is holding 24% shares of OSL as well. So we looked at earlier, Ajanta is a what? Executive director of the first company, ELP. ELP. ELP, right? So Ajanta is an executive director of ELP, right? Holds how much of percentage shares in OSL? 24%. That's an important information, especially when it comes to consolidation. Later on, we'll look at that. Then thereafter, remaining 50% of the shareholding of OSL is held by 4 family members, equal ownership. Equal ownership means what? 12.5% each by 4 people, altogether how much? 50%. So this is the shareholding structure of OSL. And if you look at the financial statements, you would figure it out. OSL also has an investment in an associate. By looking at the financial statements of OSL, you can look at, so information is given, OSL has also made an investment in an associate, yet again, but with regard to this associate, all the details have not been given, like how much of percentage holding by OSL in that associate is not given. So limited information is given, but we know that, okay, there's an associate, right? Maybe, probably, the details will be given in the unseen. So as I said, in the consolidation area, we'll discuss that in detail. Right. So this is actually the information about the two companies, what is mentioned in the pre-scene. Now, as I mentioned, so there are 3 areas in this presentation. I'm now going to talk about, first of all, what are the areas of the accounting standards that can be tested when it comes to the unseen scenario, right? So thereafter the consolidation, after that finally analysis and the interpretation section, right? So this is actually, I have directly taken from pre-seen. So according to this information, because if I read this particular information, what it says is revenue fell sharply from 576, 772 million in 2023, that is the last year, to 447,352 million in 2024. There's a sharp decline in revenue, making, what is the decline? 22.4% decrease that adversely impacted gross profit. Obviously, revenue drop has an impact on gross profit, which dropped by 40.1%. Revenue drop is 22.4%, right? Then the GP drop by 40.1% to 76,050 million. Okay. Obviously, revenue drop, GP drop. What is the next indicator? Operating profit. Operating profit experienced an even more severe decline, falling by how much? 53.9%. Operating profit decline to 29,851 million, driven by both reduced revenue and increased the selling and distribution expenses. If you look at the financial statements of the company, right, ELP, we figure it out. So there's a drop in revenue as well as increase in the selling and distribution expenditure. Additionally, in 2024, profit before tax and net profit plummeted by over 54.7% and 28.5%. So finally, PBT and net profit, PAT, is also came down by significant percentages, 54.7% and 48.5% respectively, underscoring the profound defense of financial challenges of the company's bottom line, right? So when you read this information, what is the thing, or what is the accounting standard that comes to your mind? Where once the company is facing for a drop in revenue, drop in profit, there may be a situation where company need to do an impairment testing. That means impairment indicators are available. So we understand in LKS 36 impairment of assets standard, when you find out there are impairment indicators, what we need to do? We have to do the impairment testing, right? So the impairment testing means you have to compare the carrying value with the recoverable value. What is the impairment indicator? Drop in revenue, drop in profit. So when it comes to the impairment testing, we know that if possible, do the impairment testing for individual assets. If not, you have to do the impairment testing at least at cash generating unit level. So most of the companies actually do that at the cash generating unit level. So in the unseen, examiner can give you a scenario about one particular unit of the business, cash generating unit, and these are the carrying values of the assets, and information would be given about the recoverable amount. You need to calculate the recoverable amount, which is the higher of value less cost to sell and value in use. Take the recoverable amount and compare that with the carrying value. If the recoverable value is less than the carrying value, you have to book the impairment loss, right? That's an area where examiner can test in the unseen. And also you should remember, if it is a cash generating unit, you find out, let's say there's an impairment loss. So then what is the order of allocating that impairment loss, right? Because if it's an individual asset, first of all, or basically if it's an individual asset, entire loss you allocate to the particular asset, debit P&L and credit that asset. But if it is a cash generating unit, you have group of assets. Where should I allocate first? After that, where? You should know. So we learned that, first of all, you allocate to the individual asset which are obviously impaired, demolished assets. If the information is given about a particular asset where there's an impairment, loss in value, those are called as demolished assets. So assets which are obviously impaired, you allocate there first, and thereafter to the goodwill, if it's a cash generating unit, right? And after that to the other assets on the pro rata basis. So there are certain rules that you remember when allocating this impairment. I'm not going to explain and to explain about entire thing about the what you call allocation, because there are certain rules when you are doing the allocation. Hope you can remember those rules. If not, please go and read the tutors or watch the videos what is available. Right. So that is first thing that you need to understand. Then adding to that, so this is another para what I have taken from the pre-scene. Let's read this particular para as well. So then I would ask another question. What it says at the meeting, board of directors or the board expressed significant concern regarding the ongoing issues and poor financial performance of the financial year 23-24, as it has been observed for the first time since the company's establishment. Okay, for the very first time, company has a long history, but for the very first time, they are undergoing certain poor financial performance, and there are certain operational issues as well. So the board is concerned about this. What it comes to your mind in this particular scenario now? Take this together with the earlier information, what it was given over here. Drop in revenue, drop in profit, plus board is concerned about the poor financial performance. Significant concern about the issues. What it comes to your mind? What is the applicable standard here? LKS1, presentation of financial statements. Where? What section? Going concern, right? So when you are preparing the financial statements, you assume that entity has a going concern unless otherwise management intends to liquidate the entity, or else management wants to cease the business operation, or else there is no other realistic alternative but to do so. So basically, so you assume that the entity is going concern unless otherwise management wants to liquidate or cease trading. So when you are doing this going concern assessment, at least you have to look at the 12 months from the reporting date. Okay, from the reporting date, at least look at next 12 months. Now, if you look at this particular scenario, I don't think that there's a going concern issue for this entity. Because if you have a going concern issue, or if the going concern assumption is not applicable, you can't prepare the financial statements by using the going concern basis, where you have to use a different basis of preparing the financial statement, right? But I don't think that in this scenario, you have a going concern issue for this entity. Going concern assumption is still valid. But the standard further says that if you have any material uncertainties resulting a significant doubt about the going concern, you have to explain those material uncertainties. Like what? Let's say if your overdraft balance is getting increased, right, over the period, and your short-term debt are getting accumulated, and the banks are not extending you the support, your liquidity ratios are getting deteriorated, you are losing your customers, right? Competitors are getting more and more powerful. So if you have those uncertainties, what you do? You have to make a disclosure. Okay, these uncertainties are there, but still entity believes that we are a going concern entity, and these are the remedial action that we are going to do, right? That has to be disclosed. So that's what with regard to this particular information. And also what I have done is actually I have done some research about the logistic industry, right? From certain publicly available information of top companies like Haley's, even Aiken Spence. So I have taken this directly from the Haley's annual report about the logistic industry. So that actually speaks the scenario what we have in this pre-scene, right? So now out of many sectors, one sector of Haley's is actually what? Transportation and logistics sector. So this is what is there in their management discussion and analysis. Just take a moment and see that. I think you can mirror the situation in your pre-scene. What it says? Sector's performance reflect magnitude of challenges that prevail during the year, including decline in freight rates. Okay, so one issue is what? Decline in the freight rates. Appreciation of Sri Lankan rupee. Appreciation of Sri Lankan rupee is an issue for the transportation and logistics sector. I'll explain that. As well as volatile trading activities amidst escalating geopolitical tension. So they have identified three issues. One is what? Freight rates are declining. So the freight rates are declining means what? So that is your revenue. Your revenue is getting declined. Okay. So if you are in this particular sector, then rupee is getting appreciated. So now in terms of the transportation and logistics sector, most of the time you get the revenue in dollars, in foreign currency. Now, once the rupee is getting appreciated against the dollar, what will happen? For the dollar, that the amount of rupees that you get is getting reduced. That will also have an impact on your top line as well as the bottom line. And also, in this particular financial year, a lot of geopolitical issues, tensions were there, like Red Sea issue, because of the wars and all that. So there are a lot of geopolitical issues that has caused to have a decline in performance in this sector. Now look at what has happened to the performance of the transportation and logistics sector in Haley's. What has happened? Accordingly, look at that. Revenue declined by how much? 32% to 91.35 billion, while profit before tax also declined to how much? 3.36 billion from the record high of 15 billion of the previous year. Look at this. Profit before tax, previous year, that is 22-23, was 15 billion in this sector. It has come down to how much? 3.67 billion. The large drop is because of the what? Matters what I have mentioned earlier. So this is an industry-wide issue. Not a most of the, like if you look at the situation of most of the other companies, even in the transportation and logistics sector, where I referred another annual report, Aitken Spence also have a, logistic operation, transportation operation. There even the situation is same, right? Against the backdrop, sector strategy reflected its effort to, okay, so thereafter their strategy. So this is what I wanted to mention. And even the graphical presentation, this particular line chart is the revenue drop. And thereafter these two bars, what is mentioned in orange color is actually the operating profit. You see the decline in the operating profit. And what is there in green, light green is profit before tax. You see the decline in the profit before tax last year to this year, right? So that's why I said that I don't think that there are going concern issues for the particular entity, but if you have any material uncertainties about it, you have to disclose, okay, these are the uncertainties, and thereafter, what are you going to do with those? So to overcome these challenges, right? Okay, that is with regard to the first set of information what I have extracted from the pre-seed. Then we are looking at one of the most important part with regard to the application of SLFRS 15, one of the favorite topic of the examiner, right? Repeatedly questions are tested in terms of SLFRS 15, revenue recognition standard. So let's read this information, what is given in the pre-scene first before moving to our discussion. As a diversified company, ELP operates in various sectors, including freight forwarding, air and sea both. Thereafter, domestic transportation, warehousing with modern facilities for storing import and export cargo, custom clearance house agents, custom clearance services, and packaging and moving, that is personal luggage and all, packaging and moving from one place to the other. Right, so it explains about the businesses which are carried out by ELP. Thereafter, earlier even we looked at the other companies, OSL, so which is a what? Non-vessel operating common carrier. Non-vessel operating common carrier, which performs all the services of a carrier, but company doesn't own any vessels, right? As I mentioned earlier, you don't need to have a detailed understanding about the industry, right? Because examiner aware about it, right? Because some of the students are not exposed at all to this industry, in terms of the logistic industry, right? It's a special kind of an industry. He knows that. But good to have some understanding about the way the things are working, where I'll give you a simple explanation about it. Before that, so here, what can be tested in the exam in the unseen is application of SLFRS 15, revenue from contracts with customers. If I take one example, let's think about the transportation, right? So the ELP provides transportation service to the customers. You transport goods from one place to the other. domestic transportation. Actually, what they involve is in the domestic transportation. Now, what you do is, when it comes to revenue recognition, you have to apply this 5-step model for the recognition of revenue in terms of the revenue that the company is recognizing. So if I take that particular example, so these are the 5 steps that you need to use. Identify the contract with the customer. So there's an agreement that you entered into to provide a particular service to the customer. So that is the contract that you have entered into with the customer. That is the step number 1. Step number 2 is to identify the performance obligation in the contract. What is the performance obligation here? Transport the goods from this place to that place. That is the performance obligation. What I need to do as the seller, as per the contract? Determining the transaction price. What is the consideration that I'm going to get from the customer by providing this service, transportation service? That is the determination of transaction price. So thereafter, allocate the transaction price to the performance obligation. Here, I have taken only one performance obligation, but you looked at, so this company ELP is providing multiple services. So in a single contract, there can be number of services, what I have mentioned earlier. So then what you do is, so these services needs to be identified as distinct performance obligation, where sometimes you might have one figure as the transaction price. So then what you do is that particular transaction price you need to allocate to each distinct performance obligations, right? That is step number 4. Then step number 5 is to recognize the revenue once each of the performance obligation is satisfied. Here, step number 5, we have to decide at the inception of the contract itself whether the particular performance obligation is going to be satisfied over the period of time, or whether the particular performance obligation is going to be satisfied at a particular point in time. So I'm not going to explain the rules in detail, right? Hope you are aware about this. It is very important, right? So if you believe that the performance obligation is going to be satisfied over the period of time, you have to recognize the revenue by using the progress towards the completion. If it's going to be satisfied at a particular point in time, then you have to recognize the revenue once the control is passed. Okay, what is the point at which the control is passed? At that time, you recognize that as the revenue. Right. So the most important thing is what's going to happen with regard to the 5 different business activities that ELP is carrying out. Now, with regard to the business activities, if you look at, except for the warehousing, in all other cases, right, based on the limited information what is available in the pre-scene, so the performance obligation is satisfied actually at a point in time. Now, freight forwarding means what? So the freight forwarder is the intermediary between the shipper and the different types of transportation services. So the freight forwarder is the one who actually support shipper, right, to decide what is the transportation mode, what is the route, right? Then also to allocate or to book the space of a particular shipping line. Thereafter, in terms of the custom clearances, in terms of the documentation. So in all these things, actually freight forwarder supports the shipper. So with regard to freight forwarding, so the performance obligation is satisfied at a particular point in time. So you have to recognize the revenue at that particular point in time. So that's why it's point in time in terms of the satisfaction of the performance obligation. Then this one is straightforward, that you know, transportation. You transport goods from one place to the other, right? So let's say you transport items from Colombo to Kandy. So when to recognize the revenue? Once the particular performance obligation is completed. Again, what? At a particular point in time. Okay. Then in terms of the warehousing, where let's say you provide the warehousing services for another party. So in that case, the performance obligation is satisfied not at a particular point in time, right? Over the period of time. So the seller performs the service and customer consumes the service simultaneously. In that case, the performance obligation is going to be satisfied over the period of time, right? So yet again, custom clearances straightforward. So once the clearance done, so the performance obligation is satisfied, point in time. And also packing and moving the personal items. So yet again, once the, once you once you have complete your job, right? At that particular point in time, performance obligation is satisfied, you can recognize that as revenue, right? So this is actually, as I said, based on the limited information what is given in the pre-scene, depending on the type of business, I analyzed and explained to you the satisfaction of the performance obligation, whether it is actually at a particular point in time or over the period of time. I hope you understood. Very important, right? Okay. Examiner can easily test a question, right? Yet again, why it was, I have done some research yet again. So this is taken from the annual report of Aiken Space, right? So the 23-24 annual report. So there you have now here, there are 5 types of business activities. No, so you have been given information about 4 out of these 5 activities. No information is mentioned about the custom clearance, but the other 4, you have been given the information. Now, first of all, freight forwarding and courier. Courier is something similar to this one. Okay, packing and moving the personal effect. Now, there it's clearly mentioned, as I explained, revenue recognition for the freight forwarding and courier operation is recognized at particular point in time. Okay, freight forwarding and courier operation. So then under the integrated logistic, it says, so there are some businesses which are not there in our list, right? So with regard to integrated logistics, at a point in time for CFS depot transport. So take what is necessary, right? Forget about the rest. Okay. Point in time for transport, domestic transport, then distribution, container repair, and other special operations. So what you need to focus only about the transport. That is what is applicable for us. And thereafter, over the period of time, over time for what? Warehouse and mobile storage solution. Forget about the mobile storage solution. Over time for the warehousing, point in time for the transportation, right? Freight forwarding, point in time. Domestic transport, point in time. Warehousing, over time. Custom clearance, even though it's not mentioned, this is simple and easily understood. You recognize the revenue once the particular performance obligation is satisfied at a particular point in time. And this is something similar to courier service. So the packaging and moving the personal effects, that is also point in time, right? Important information, right? So actually, I have done a lot of research by looking at the annual report. So where you don't need to do any research, right? You have to focus your exams. You just have only, limited time. So that's why I put all this information to boost your confidence, right? Even though you have not gone through, now it's like you have already gone through about the important sections of the annual report, which have been already published by now, right? Okay, then the other company. So OSL. So OSL is in the business of non-vessel operating common carrier. So what is this? This is a special kind of business activity. Some people believe this and freight forwarding is same. No, there's a difference. That is, what these guys do is they don't own vessels, but they book the space of shipping lines, right? And that space that they book, because they are actually booking a large space, then the space that they book, they sell it to the shippers as well as small freight forwarders. Okay. So what they do is, even though they don't own vessels, they book the space at a lower price and then sell it to the shippers, that means exporters, as well as sometimes small freight forwarders as well. Because why? Rather than directly buying from the shipping line, so these individuals and the small freight forwarders finding it cost effective to buy or to get the space from these people. Because why? They already book a very large space at a lower rate. Because when you book a large space and when you're continuously doing that, you get a better rate. But the risk is what? Let's say you buy the space. If you can't find out the customers, still you need to pay that amount to the shipping line. So that is the risk of the business. Right. So that is the business of, that is what is mentioned as non-vessel operating common carrier. So here also, performance obligation is satisfied at a particular point in time. Once the performance obligation is fulfilled at a particular point in time, you recognize the revenue. Okay, so that is the application of SLFRS 15 in terms of this particular case study. So as I said, examiner can easily, test a question in this area by looking at the business activities that these companies are carrying out. Right. Then moving to the next area, that is LKS 21. So I already explained to you, in this industry, so what happens is companies are dealing in foreign currency, right? So you are invoicing your customers in foreign currency. And you have agents all around the world where you are making the payments to these agents in foreign currency. So there can be a question in terms of LKS 21 with regard to the what? Identification of functional currency of the entity. What is the functional currency? The definition of the standard is functional currency is the currency of the primary economic environment in which entity operates. Now, this is a Sri Lankan company. We have to decide whether the functional currency is rupees or whether the functional currency is dollars. Let's say most of the things are happening in dollars. So the invoicing as well as the payments are taken place in dollars. So that is functional currency. Then foreign currency means what? So other than the functional currency, any other currency would become the foreign currency. Now, let's say if you identify rupees as the functional currency, foreign currency is the what? Dollars. Okay. And the presentation currency is the currency in which you actually prepare and present your financial statement. Sometimes there can be a situation you might identify dollars as your functional currency. We'll look at what are the factors that you need to look at. But still, for the purpose of the local owners, investors, tax authorities, so you prepare the financial statements in rupees. Okay, so you should understand what do you mean by functional currency, foreign currency, and the presentation currency. Yet again, I'm not going to discuss in detail. If you can't remember what it is, please go and watch the tutorials as well as the videos. Right now, in this particular scenario, the application in the exam is, examiner might ask you by giving information what is the functional currency of this particular entry, whether it is rupees or dollars. So where you need to look at these criteria. So there are actually three main factors that you need to look at. One is what is the currency that influences the sales prices of the goods and the services, which means what is the currency in which you invoice, whether it is dollars or rupees. Thereafter, if you look at this, what is the currency in which you incur your main cost, like labor, material cost, other cost. So in this particular industry, you have a lot of agencies, right? So what is the currency in which you make the payment? And what is the currency in which you make the payment to your employees, right? And what is the currency where the comparative forces and the regulators determining the sales prices of the goods and the services. Now, by looking at these factors, you need to make a decision. But here, I don't have the information given in the pre-scene to decide whether the functional currency is rupees or dollars. So that is not available. By looking at the information given in the unseen, you need to make the call. In addition to these three main factors, there are two more factors so not as important as the first three, but there are two more factors given in the standard. One is currency in which financing activities are generated. That means what is the currency in which you are taking the bank loans. Okay, if you need financing, what is the currency in which you finance your operations? Then what is the currency in which your operating cash receipts are retained? Once you generate profit, money, what is the currency in which you keep that, you retain within the business? So as I mentioned, so these two are also ancillary factors to decide the functional currency, but this is the most important three things. So by looking at this, but normally if you are tested this in the exam, So the some factors supports that the functional currency is rupees, and some factors supports that the functional currency is dollar. So there, what you do is you have to use your judgment to decide the functional currency that most faithfully represent the economic effect of the transaction. You have to look at, okay, for whether it is for rupees or dollars, where the most of the factors, if the most of the factors supports rupees, right? So the functional currency would become rupees. So the weightage is mainly on rupees. But if it is other way around, it has to be in dollars, right? That decision has to be made based on the information available in the unseen if it is testing the examination. And then let's say after doing the analysis, let's say you conclude, okay, even though there are certain foreign currency revenue is generated by the entity, even though there are some payments are made by the entity in foreign currency that is in dollars, still I made the judgment by looking at all the factors. So they are mixed indicators. Let's assume I made the decision functional currency is rupees. So then thereafter, what you need to understand is now if the functional currency is rupees, so the dollar transactions are to be considered as the transactions in foreign currency, because I told you once you identify your functional currency, any currency other than the functional currency is foreign currency. So then when it comes to these dollar denominated transactions, due to the changes in the exchange rate, rupee against the dollar, there are exchange gains and the losses. If the transactions are settled during the financial year, then you have realized exchange gains and the losses. But if the transactions are not settled by the year end, let's say you have done some sale, it is in a receivable account, invoiced in dollars. On the other hand, you have taken some services from the foreign suppliers, you receive the invoice in dollars, but the year end you have not settled that. That means you have dollar denominated receivable and dollar denominated payable balances are available. Then what is applicable? So LKS 21 says that if you have monetary items like what? Receivable, payable, right? So those are to be converted by using the closing exchange rate, reporting date exchange rate, and you need to book any unrealized gains and the losses. So these unrealized gains and the losses are taken to the profit and loss statement. Okay. And I'm not going to talk about these like non-monetary items in foreign currency. Like example, let's say if you have a property in a foreign country, then it's an unmonetary item, right? In this situation, you don't have those, right? So if it is tested, what's going to be tested is actually monetary items, receivable, payable, even foreign currency loan. If you have taken a foreign currency loan, that is also a monetary item. Most of the liabilities are monetary items because you know the exact amount, exact number of units of currency that you need to pay to settle the obligation. Then those are monetary items, right? So if it is a monetary item, ensure that you translate by the closing rate and book the unrealized gains and the losses. So those unrealized gains and the losses are also taken to the profit and loss statement, right? So that's also clear. Okay. So what are we discussing? We are discussing about the accounting standards related areas in this particular pre-scene, right? So we discussed now multiple areas, number of areas, important areas. So there are a few more areas that we need to look at. What else? So here it says another extract from the pre-scene. In the logistics sector, ELP has implemented cutting-edge technologies such as AI, artificial intelligence, then the Internet on Things, IoT, and blockchain to optimize the supply chain and delivery services. Right? Seems that a lot of intangible assets. So the company has invested in a lot of intangible assets that ensures companies' operational efficiencies are enhanced, as well as company can achieve long-term benefits out of these new technologies. So in the pre-scene, you have been given a lot of information about these technological improvements. Okay. So, and also if you look at the financial statement later on, I'll go through the financial statements of the two companies. You will look at that. So a lot of intangible assets or significant amount of intangible assets are recorded. So what is the applicable standard to this? LKS 38 intangible asset standard. So intangible asset can be generated in three ways. It can be a separately acquired intangible asset or intangible asset generated through a business combination or internally generated intangible asset. So whatever the way, the initial measurement should be at cost. Now, if it is separately acquired, no issue, the purchase price, acquisition cost is the cost. Now, I don't think, okay, so the business combination within the console part that can be tested. If you, let's say if there's a subsidiary and subsidiary has a brand, that particular brand is an internally generated brand to the subsidiary. So that particular subsidiary has not recorded the brand in the financial statement of the subsidiary. The reason is what? It is an internally generated brand. Normally, internally generated intangible assets are not recognized in the financial statements. But when parent company acquire this subsidiary, what the standard says is parent company has to identify all identifiable assets and the liabilities of the acquired subsidiary. Even this particular brand, parent company has to recognize at fair value in the consolidated financial statements. So the initial recognition is at cost, but what is cost in the case of a business combination, which equals the fair value? Okay, I hope you know this principle. Discuss this when we are discussing the theory, as well as this has been repeatedly tested in number of examinations. Then, as I said, normally internally generated intangible assets are not recognized in the financial statements, like internally generated brands and all. But even though it is internally generated, if you can find out this research and the development process in internally generated intangible asset, then the cost what you incur in the development phase, not in the research phase, cost incurred in the research phase, you need to expense because that's an experiment that you are doing to find out new or improved knowledge. Then the development phase means application of the research findings. You have some sort of a certainty. So the cost incurred in the development phase, you can capitalize subject to the satisfaction of 6 recognition criteria, right? So there are 6 criteria. Upon satisfaction of these 6 recognition criteria, the cost what you incur in the development phase can be capitalized. And with regard to the subsequent measurement, you have the cost model and the revaluation model. Cost model means cost minus amortization minus impairment losses. Revaluation model means you revalue the item, then that revalued amount you need to amortize over the remaining useful life. And if you have any impairment losses, yet again you deduct. But you should understand the standard specifically says that for the intangible asset, not for the property, plant, and equipment, right? For the intangible asset, for you to apply the revaluation model, there should be a what? Active market. Without having an active market, you can't apply the revaluation model as the subsequent measurement model. For most of the intangible assets, actually, you don't have active market because these intangible assets are unique most of the cases. So in that case, you don't have the revaluation model. You must follow the cost model, right? Okay, so when we go through the financial statement, we look at, so as I mentioned, we have a significant amount in the intangible assets. Right, moving on. What else? It is important. I'm looking at each and every area that can be tested in the exam, right? So if examiner wants to, have the link between the pre-seen and the unseen, definitely if it is an accounting standard question, it has to be something out of these things because there's nothing else. Now, thereafter, another extract from the pre-seen, considering the company's steady and sustainable growth, board decided to expand the business by acquiring its own transport fleet and modernizing its warehouse to world-class standards, which could also be rented out to the others. So this has happened actually with the listing. So with the listing, company actually generated funds. So all of these funds, what they did was they have invested in their own transport fleet that is used for maybe for the domestic transportation. And thereafter, they upgraded the warehouses to the world-class standards. Okay, very simple. I know that it's too easy, but still I have to tell that. So what's the applicable standard? If it is your own assets, own occupied assets, it is what? LK 16, property, plant, and equipment, right? So, so these vehicles you need to recognize as PP&E, as well as warehouses, buildings you have recognized as PP&E. There even you have 2 models subsequently, either cost model or the revaluation model. So I'm not going to explain about these. I have already explained about the these two models in terms of the intangible assets as well. But remember, in terms of the PP&E, you don't have the restriction, right? Because if it's an intangible asset, for you to use the revaluation model as the subsequent measurement model, you have to have an active market. Here, that particular restriction is not there, right? Even though the PP&E doesn't have any active market, you still can use the revaluation model, right? This is simple and straightforward, right? And also, I want to touch upon SLFRS 16 because in terms of this particular case study, by looking at the business that they are in, right? They are into transportation, warehousing, freight forwarding, right? So they might have a lot of lease agreements entered into. Even if you look at the financial statements of the company, you will figure it out. There are right of use the asset and the lease obligations. These right of use the asset and the lease obligations may be relevant with relevant with even the domestic vehicles, even with regard to the warehouses, right? In addition to that, this particular company might have leased out certain aircraft. We don't know. They might lease out certain vessels. We don't know. So that might be the assets. What is there in the balance sheet as the right of use the asset and the lease liabilities. So applicable standard is what? SLFRS 16, right? So important standard, I would say, this is one of the favorite area of the examiner as well, SLFRS 16. So the question is tested from the lessee's side. Now, you know, from the lessee's side, there's no classification as finance or operating lease. It's a lease. So the lessee has to recognize lease liability and the right of use asset in terms of the all leases that lessee has entered into, except for the two exemptions given in the standard. So if it is a short-term lease, 12 months or less, or if the particular underlying asset is a low-value item like you know, computers or the office furniture, other than these two, in all other situations, so the lessee has recognized the lease liability and the right of use the asset in the statement of financial position. Then the lease liability is subsequently measured at amortized cost, and the right of use the asset is subsequently getting amortized over the lease term, right? So, but if it is a short-term lease or the low-value item, what you do is you charge the amount what you pay to the P&L on straight line basis without recognizing the lease liability and the right of use the asset. I don't think that examiner would test this, but you should understand, you should know, should be familiar with lessee accounting in terms of the lease liability and the right of use the asset with regard to the scenarios that I have mentioned. As I mentioned, they might enter into lease arrangements to get some vessels, to get some aeroplanes, right? Okay. What else? What else? Another information. Additionally, recent data breach attributed to inadequate cybersecurity measures comprised sensitive customer information and exposed the company to potential legal and financial liabilities. So these deficiencies not only pose serious legal and financial risk, but also undermine investor trust and compromise the operational integrity, right? So what is all about? There are some breaches in terms of the sensitive customer data. You know, now in Sri Lanka, Data Protection Act is enacted, right? So you can't reveal sensitive customer information. So you can't use it for your business purpose, as well as you can't give it to somebody else. Now here it seems that this company is using technology up to a great extent. So the hackers might, you know, log into your system and get certain sensitive information. Then you are responsible for that. So there can be litigation. So what standard comes to your mind? LKS 37, provisions, contingent liabilities, and contingent asset. So depending on the scenario given in the unseen, so if there's a court case, what you do is you have to check that whether a provision has to be recognized in the financial statements. To recognize a provision, how many conditions are to be satisfied? 3 conditions. There should be a present obligation as a result of a past event. It has to be either a legal obligation or a constructive obligation. So in this case, mostly a legal obligation. Legal means that is because of a law enacted in the parliament or because of a court case, right? Or else because of a contract. So in this case, most probably if it is tested, it would be a legal obligation, right? So there should be a present obligation as a result of a past event. Then outflow of the economic benefits are probable. Probable means what? More likely than not. More than 50% chances they are to happen the outflow. And the amount, the value or the amount can be measured reliably. So in that case, you have to book the provision as provision you have recognized, and also you make certain disclosures. So it depends on the, if it is tested, it depends on the unseen information, where examiner might make a small change, right? For example, let's say the same example. So somebody has filed a case against you, right? Now the court case is going on. You have your lawyers. Once you consult from the lawyers, what they said was, okay, we have done something wrong. There was a mistake, but we can defend the case. When you ask them, okay, what is the probability of losing the case? They say that, okay, you have 30% probability of losing the case. In that case, is it a provision? No, because why? Outflow of economic benefits are not probable. It is only possible. Then what is that? It would become what? Contingent liability. You just need to disclose, right? So be aware. So this is actually the summary in terms of the probability, in terms of the asset and the liabilities, what is the accounting treatment would be. Now, if you look at, let's understand these terminologies first. What this terminology says in, I'm explaining fast. Hope you know this. Virtually certain means what? 95% or more. Probable, this is the only terminology what is defined in the standard. Other three are actually accounting practice, right? So the probable is defined more likely than not. What does that mean? More than 50%. More than 50%. Then possible means 50% or less. Even if it is 50 possible, 50% or less. Remote means what? 5% or less. Now, as I said, now if you go back, accounting treatment. So in accounting, we are prudent. If it is a liability, loss, book it. If it is an asset, gain, income, be careful, right? So if something is virtually certain, right? So if it's a liability you provide, asset you recognize, virtually certain, almost certain. If it is probable, if it is a liability, if a liability is probable, more likely than not, what do we do? Provide, provision, provide. But if an asset is probable, more likely than not, what we do? We just disclose that. Prudence, liability provide, but asset disclose. If a liability is possible, possible means what? 50% or less. What do? Disclose, contingent liability. If an asset is possible, no disclosure. Finally, if it is remote, even a liability is remote, 5% or less, no disclosure. Obviously, assets, if it is remote, no disclosure. Right? So, update your knowledge. Right. Moving on. What else? Few more. So here, another extract which I have taken from the pre-scene is what? Manage the growing business. The company recruited 2 managers to head the expanding departments as well as additional staff, increasing the total number of staff to how much? 250. What it comes to your mind? When we talk about the employees, in terms of the accounting, what it comes to your mind? Employee benefits, LKS 19, not tested for a very long period of time, right? So now you have 250 employees, means fairly a large organization. And also based on the information what is given in the statement of financial position and the other comprehensive income, we figure it out. They have a retirement benefit plan, retirement benefit obligation. And also actuary is getting involved in the valuation. That's why you have actuarial gains and the losses under the other comprehensive income. So what examiner can do, as he has not tested this standard for very long period of time, right? Bit of a complex standard as well, comparing with the rest. So he can test a question. So where you should apply the principle of the standard. So especially if it is tested, I believe that the question is tested in terms of the post-employment benefits. Even in the post-employment benefits, you have 2 types, defined contribution plans and the defined benefit plans. So if it is tested, what's going to be tested is most probably defined benefit plans. So apply the main principle. What is the main principle of the standard? Yes, employee benefits are paid once they retire, but still you have recognized the cost when they provide the service to the company. You can't wait to recognize the cost in the P&L until they retire. So the benefit would be paid after they retire, post-employment benefit, but still the cost has to be recognized now. Right? So that is the main principle. Then you have different types of employee benefits. I explained about the post-employment benefits like pension plans, gratuity obligation, EPF, ETF, right? So there are two types of post-employment benefit plans: defined contribution plans, defined benefit plans. Be thorough with that. Then short-term employment benefits like salaries, bonuses, and all. Termination benefits. Let's say company has a voluntary redundancy scheme. So the employee has accepted this scheme. So the company agreed to pay him 12 months salary. So that's a what? Termination benefit, right? Because of the employment is getting terminated, company agreed to pay 12 months salary. It's a cost to the company. Benefit to the employee. You recognize the cost. Termination benefits. Other long-term benefits. If anything not coming under the first three category, then it would come under the other long-term employee benefits. Like what? Long service awards, right? Then thereafter, long service leave. When you work for the company for 7 years consecutively, you are given 6 months paid leave. Long service leave, other long-term employee benefits. So the first four categories are covered under LKS 19. And also if you have employee share-based payments, so that is covered under SLFRS 2. But in the case study, no information given in terms of the share-based payment scheme. So I don't think that examiner will go to the go and test about the share-based payments. But with regard to the employment benefit, they are most likely would be the post-employment benefits can be tested as you have a defined benefit plan in this particular question. And also there's an involvement of an actuary where you have 250 employees in the company. And also, as I mentioned, it has not been tested for a long period of time. Right, these are I explained with regard to the post-employment benefit plans, two types: defined contribution plans, things like EPF, ETF, and defined benefit plans like pension schemes, then the gratuity defined benefit plans. I'm telling you, I don't have time to explain the theory, right? I'm telling you the important areas where what you do is you have to judge by yourself where I'm standing now. If you understand the things what I said, very good. But if not, you have to quickly brush your knowledge about these areas very quickly because you don't have that much of time when it comes to the examination, right? Then, okay. Then what I did was I have included the financial statements to see are there any missing topics. So I have discussed now number of things, right? In addition to that, are there any areas which are important for the accounting standards? Let's look at that aspect as well while we'll go through the financial statements. So this is with regard to the main company, Ecom Logistics PLC, ELP, right? Statement of financial position and thereafter the profit and loss statement. So going through that, I discussed about the PP&E, right? I discussed about the right of use asset. I discussed about the intangible asset. Then with regard to the investment in associate, very important, in consolidation, I will discuss. And one thing that you note here is, if you look at the investment in associate value, last year to this year, it has been reduced, right? So you have to look at why it is. Actually, that is because this particular associate that the company has is making what? Losses, right? So once associate is making losses, share of loss is getting deducted from the value of the investment, equity accounted balance of the investment. We look at that in the consolidation. Then small value of financial assets, then deferred tax assets, right? So here, this particular company has a deferred tax asset, right? So what is the applicable standard? LKS 12. So we'll discuss a little bit about LKS 12 after going through the entire thing, after identifying what areas are important. So after identifying all areas, let's look at bit about LKS 12 income tax standard, right? Then inventories. Now, if you look at the logistic industry, so this transportation and logistic industry, you don't have that much of inventory. So I don't think that because of that, examiner is going to test LKS 2 inventory standard, but this is yet again the industry practice, right? Where normally one of the main asset in the logistic industry is actually what? Trade and other receivable, Okay, because when it comes to industry, less inventory as well as comparatively less long-term assets. But you have a lot of trade receivable. When it comes to trade receivable, what is the applicable standard? SLFRS 9 financial instrument standard. So they are even impairment allowance computation of the trade receivable can be tested. We'll take that one as well into our discussion. Then prepayment and the other assets, small value of financial asset, then income tax recoverable, cash. Cash balance is also significant. What's the applicable standard? How to account for cash is covered under what standard? Cash is a what? Financial asset. SLFRS 9, but I don't think that exam is going to test a question about cash in the exam. Then you have the equity section, share capital, reserves, then the retained earnings, liabilities, borrowings and lease payable. So SLFRS 9 again, financial liabilities. Retirement benefit obligation, I already discussed. Then under the current liabilities also, borrowing and lease payable, pay other payable, then income tax liabilities. Yet again, with regard to trade and other, trade with regard to trade receivable as well as trade payable, I already explained to you, there can be foreign currency denominated figures. If you have foreign currency denominated figures, those are considered as monetary items, monetary assets, monetary liabilities. So what you do, you have to convert by using the closing exchange rate and recognize the unrealized exchange gain or loss at the year end. Right. So two areas which you have highlighted. One is deferred taxes, other one is impairment allowances of trade receivable. Okay. So then P&L revenue we discussed, cost of sales, gross profit, other income. So in the pre-scene it was mentioned the S&D cost has gone up, right? That is there. Administration expenditure, admin expenses have come down actually. Then finance cost, finance income, and share of associate profit. You see, in both years, this particular amount. So with regard to associate, what you record in the P&L, share of associate profit after tax. If you can remember at the very beginning when we were discussing about the companies, we discussed ELP held, right, 26% holding of the other company, OSL, right? Now, what you do is when it comes to equity accounting, ELP is equity accounting OLS, the other company, because that's an associate. So what you do? You have to take share of associate profit after tax. You have to look at the financial statements of the associate OLS in this situation. Out of that, you take the profit after tax. Out of that, take 26%. Take your share. Now, both cases, current year as well as the last year, it was negative. The reason is why? The other company. Okay. The other company associate is making losses. So that would be reflected in the next couple of slides. Okay. OSL is making losses. So you have taken your share. So it's negative. And thereafter PBT, income taxes, profit after taxes. Thereafter earning per share. So obviously, as the profit has come down, earning per share has also came down. Then this is actually the other comprehensive income section of the ELP. So profit you have taken from the previous statements. Then I explained to you actuarial gains and the losses of the retirement benefit plans. Then the income tax effect of that actuarial gain or loss. Okay, not only the share of profit after tax of the associate, when you have an associate, you also need to take the what? Share of other comprehensive income. Now, associate company might have other comprehensive income items like what? Revaluation gains and the losses. Then if they have a, I'm taking hypothetical example, right? If they have a foreign subsidiary, there can be translation gains and the losses of that foreign subsidiary. In addition to that, there can be financial assets which are measured at value through other comprehensive income. So there can be gains and the losses out of them. So the point what I wanted to mention is, like you take the share of profit after tax of the associate, you also need to take the share of other comprehensive income items of the associate and take your share and put under the other comprehensive income. Okay, so that is what you have taken here, share of other comprehensive income of the associate. If you don't understand, doesn't matter. When it comes to consolidation area, the most important area of this entire presentation, I'll discuss that in detail, right? Okay, so still two areas financial instruments, that is impairment allowance computation of fair receivable and the deferred taxes. So these are two things I'm going to discuss in a little while. And this is actually a set of financial statements of OSL, right? OSL. So, so they are, yet again, you have PP&E, capital working progress, right? So then investment, okay, here. So OSL also has an investment in associate, but that value has gone up. Might have been that particular associate where the OSL has invested is doing well, right? Even if you look at the P&L here, share of profit of the associate, it's plus. So OSL also invested in an associate, but the information is not given about the percentage holding and all, right? What is the name of the associate? Nothing is given in the pre-scene, but seems that that associate is doing well. So your share of profit is positive, right? So the value of the investment is increasing. Okay. So seems that this time, when it comes to consolidation, LKS 28, investment in associates and the joint venture is very critical. Okay, we have to look at that. What are the possible questions that can be tested in the consolidation area, right? We'll do that after analyzing the analyzing all the accounting standards, right? Then you have financial assets. Then look at deferred tax. Here, last year there was a deferred tax asset. Now it's not there. Have we de-recognized the deferred tax assets? Right? So, because to recognize the deferred tax asset, you should be sure that you can recover the value of the deferred tax asset. Now, last year there was a figure, now there's nothing. Why is that? Okay, let's look at that. Again, inventories, trade and the receivable, financial assets, cash and cash equivalents, stated capital under the equity, capital reserves, retained earnings, same stuff, right? What we discussed earlier. Then the non-current liabilities, long-term borrowings, financial liability under IFRS 9, deferred income tax liabilities, deferred taxes, retirement benefit obligation. So this company also has a retirement benefit obligation as well as certain, do we have any actuarial gains and the losses? Yes. So there are actuarial gains and the losses as well out of the retirement benefit plan. Then current liabilities, trade and other payable, short-term borrowings, right? Then statutory payable like tax payable, then the accrued expenditure, nothing much. Then if you look at P&L revenue, direct operational expenditure, gross profit, other income, administrative expenditure. Then they have taken the earnings before depreciation and thereafter shown the depreciation figure. Operating activities profit, finance cost, and I explained to you share of profit of the associate, your share of profit of the associate. Then PBT, income tax expense, thereafter PAT, and deferred taxes. So here in income tax separately given, the deferred tax adjustment, deferred tax expenditure is separately given, right? So the massive amount is adjusted as deferred tax expenditure, right? So I told you there was a deferred tax asset that is not there in the current year. Might have been that deferred tax asset is taken out, de-recognized. Then what is the double entry? Credit the deferred tax asset, debit the P&L tax expense. So this is high, 417 is high. Might be because of that write-off of that deferred tax asset, what it was there in the previous financial year. And overall, if you look at OSL, is not doing well. At the moment, company is not doing well because company is making a loss, right? So accounting loss means there's a possibility of having a tax loss as well. If you have a tax loss, what's the standard that comes to your mind? Implication of deferred taxes again, right? We'll discuss that in a little while. Then profit for the year. After that, other comprehensive income where you have the actuarial gains and the losses. Then yet again, you have the what? Share of other comprehensive income of the associate. So similar to the share of profit, if the associate has other comprehensive income, from that even you have to take your share. You have to take your share. Then total other comprehensive income, total comprehensive income, and the earning per share. So the earning per share is negative because why? Profit is negative, right? So that EPS is negative. I told you there are two areas which you have figured it out where a discussion is required by looking at the financial statements of the two companies. One is LKS 12 income taxes, they are the most important area is the recognition of the deferred tax assets and the liabilities. So this is another area where the prudence concept come into play. So when you have temporary differences, you have to recognize the deferred tax implications. If it is a taxable temporary difference where you have to pay more taxes in the future, you have to book a deferred tax liability. On the other hand, when you have deductible temporary differences where you have to pay less taxes in the future, you might book a deferred tax asset, but when you're booking the deferred tax asset, you should be pretty sure that that particular deferred tax asset is recoverable. Now, one area where this deferred tax assets arose is actually a tax loss. Why? When you have a tax loss, what will happen? If you earn a tax profit, what you do? You have to pay taxes to the government. If you earn a tax profit. On the other hand, if you incur a tax loss, will government pay you? No, it won't happen. If you have a tax loss, what you can do is this tax loss can be carried forward and set off against the tax payables in the following years. So which means when you have a tax loss, by utilizing that tax loss, your future tax payments can be deducted, can be reduced. So that's why we say that it is amounting to a deferred tax asset, because deferred tax asset is a deductible temporary difference which will reduce my future tax payments. But when you recognize a deferred tax asset on a tax loss, you have to pretty sure that it can be recoverable, because if you believe that, now let's say if you look at a particular entity, last 5 years, it was making a tax loss, not making money. And if you look at the future even, you don't think that company is going to make a tax profit, then no point of booking a deferred tax asset on the tax loss, because why? There's no way for you to recover that tax loss from the future profits. Now, in this particular situation, you see, company has booked a deferred tax asset for the year ended 31st March 2023, but that deferred tax asset is taken out. Might be because why? Company is making losses. And even the future, at the moment, company believe that I can't make profits. Then no point of keeping the deferred tax asset. You have to de-recognize the deferred tax asset. Because why? Recovery is not certain. Right? You can't recover. So that's why when it comes to deferred tax asset recognition, recognize if it can be recoverable. Okay. So that's the point what I wanted to mention. Then with regard to application of SLFRS 9 financial instrument standard, the important aspect is, I told you, a significant amount of the balance sheet assets comprise of trade receivable, trade other receivable. So as it is significant, there can be a question from impairment loss model or the expected loss model. So this is actually the general impairment loss model. So the stage 1, stage 2, and stage 3, performing, underperforming, and non-performing. But this particular general asset impairment model, I don't think that it will be applicable for this question. Because why? If you look at this logistic industry, most of the trade receivable balances are paid within 1 year. If it is paid within 1 year, the standard allows you to use the simplified approach. That means if you do not have a significant financing component, which means if everything is getting settled within 1 year, don't go ahead with this general model and try to find out whether it is in stage 1, stage 2, or stage 3. Basically, you can't do that. What you need to do is you need to apply the lifetime expected trade loss model for all the receivable that you have. No need to go through this process of looking at stage 1, stage 2, or stage 3. So you can apply the simplified version. So by applying the simplified version of the standard, you have to calculate the amount of the impairment allowances. So just remember that particular point. Okay, so how to do the computation and all that, yet again, I don't have time to explain here. We have done a number of questions when we are doing the theory sessions. So ensure that you know that area, right? So what it says is, from initial recognition, loss allowances should always be measured at the amount equal to what? Lifetime expected trade losses for trade receivable if they do not have a significant financing component, which is the practice most of the cases in the logistic industry. Right. Okay, so finally, with regard to the standards, the final point what I want to tell you is, So here also, under the unseen scenario, you'll be given information about additional information about the group structure. So there can be, possibilities of having a group, and within the group there can be related party relationships and related party transactions. So in summary, you should understand this, but this is the diagram that you need to keep in your mind. So if you have this diagram in your mind, you can identify any type of related party relationships. So in the standard, there are two things that you do. First of all, you need to identify who are your related parties. And thereafter, once you identify the related parties, so this can be an entity or this can be a person. So with identified related parties, you have to disclose the transactions that you have carried out, and also if there are any outstanding balances at the end, that also needs to be disclosed. So if I quickly tell you, let's say your reporting entry, whatever the reporting entry that is going to be tested in the exam, if it is tested in the unseen, so the reporting entity is parent, right? Parent can be an entity, or the parent can be an individual person, or if it is a person, they are close family members, right? Would become what? Related party to the reporting entity. What is there in light blue are related parties. What is there in this red, or what you call, red, are not the related parties. So reporting entity's parent is a related party. Similarly, there can be an investor who has 35% of this reporting entity. That investor is a what? Related part to the reporting entity, because investor has significant influence over the reporting entity. Again, that investor can be an entity, it can be a person. If it is a person, that person's close family members are also related part to the reporting entity. Then this reporting entity can have a subsidiary, associate, right? That particular subsidiary and associate are related parties. Their reporting entity can enter into a joint venture with another joint venture investor. So the reporting entity is holding 50%, other investor is holding 50%. Now, reporting entity and the other investor has the joint control over this joint venture. So in that case, what is your related party? This joint venture, not the other investor. Other investor is not related party to you, but this joint venture is a related party. In addition to that, now we are looking at from the reporting entity's point of view. Now the reporting entity's parent can have another subsidiary. Now, what is the relationship between that particular subsidiary of the parent and the reporting entity? What is the relationship? You and that subsidiary is under the common control of the parent. That means reporting entity and this subsidiary is under the common control of the parent. So these are called as fellow subsidiaries or sister companies, right? Because parent controls both. Then reporting entity and this subsidiary are related parties. Similarly, that parent can have an associate, parent can have a joint venture. That associate, joint venture, and you, reporting entity, are related party. Then coming to the individuals. These are our reporting entity. Key management personnel of the entity. Anyone who has the authority and responsibility for the planning, directing, and controlling activities of the company. Include, right? So is considered to be a what? Key management personnel. Your board of directors as well as senior management, normally considered as KMPs. So KMPs of reporting entity are related parties, and close family members of the KMP are also related part to the reporting entity. That means KMP spouse, right? KMP's children are related parties to the reporting entity. Not only that, not your KMPs. KMPs of your parent. Now, this is the reporting entity and this is the parent. Key management personnel of the parent entity and their close family members would become related part to the reporting entity. So it's wide. Not only that, if any of these individuals, KMP of the entity or their close family, or KMP of the parent entity or their close family, any of these people can have a subsidiary, associate, or a joint venture. So that subsidiary, associate, joint venture would become what? Related part to the reporting entity. So keep that diagram in mind. It has all types of related party relationships. If a question is tested, you to identify, and thereafter you have to explain the transactions that you have carried out with each category of related parties and what are the outstanding balances. Okay, couple of times it has been tested in the exam. Right, okay. Right. So the large area is done, but the most important area is yet to be done. That is what predominantly your unseen. What your main focus is on consolidation, that I know. So what we can do is, I was talking more than an hour. What we can do is let's take 5 minutes break, right? Let's take 5 minutes break. That will refresh your minds because this area is the most important area. Okay, and this time consolidation question can be a tricky question. Okay, based on the information that is given in the presentation. So because of that, just to relax your minds, let's take 5 minutes break. After that, I will start. Okay. Okay, let's start. Consolidation. So we discussed about the companies, what is given in the receipt, as well as we looked at the shareholdings. So this is actually a summary of what we discussed earlier. So the first company is ELP, Ecom Logistics PLC. If you look at the ownership, this is the ownership. Roshan, he's the chairman, is having 30% of the company. Kamal, managing director, is having 30%. Ajanta, he bought actually 8% and became an executive director. And he's actually a friend of Roshan. And there's a 32% public holding as well. And this company, ELP, made an investment in OSL in 2021. How much of percentage acquired? 26% of shares of OSL was acquired by ELP in 2021. And here also given one important information, that is Roshan is a non-executive director of OSL. Now, Roshan, who has 30% ownership of ELP, right? He's a chairman of ELP, is also a non-executive director of OSL, because when ELP acquired 26% holding in OSL, ELP would have given a opportunity to appoint one director. So the director appointed would have been Roshan. So now the meaning is actually ELP has 26% ownership shares in OSL, as well as ELP was able to appoint a director in OSL. That is actually Roshan. He is a non-executive director of OSL. I hope it's clear. The other company is OSL, Ocean Shipping Line Private Limited. If you look at the ownership of that, here also it has to be ELP, right? ELP has 26% ownership in OSL. So the share, we are looking at the shareholders of OSL. 26% is held by ELP. And important information, Ajanta, there is this guy who is a executive director of ELP, holds how much? 24% shareholding of, sorry, right, Ajanta, he is an executive director of ELP, holds how much? 24% shares in OSL as well. If you look at OSL, very important, ELP holds 26% of shares in OSL, and Ajanta holds how much? 24% shares in OSL. Ajanta is an executive director of ELP. Okay, keep that in mind. Then the remaining 50% is held by 4 family members, equal ownership, maybe 4 brothers. So equal ownership means each person is having 12.5% each. This 50% would be, I would say, 12.5% into 4, 50%. Then OSL also has an investment in associate, because if you look now, we already went through the financial statements where we figure it out from the statement of financial position as well as profit and loss statement and OCI of OSL. OSL also has an associate. So they have also equity accounted for an associate, but the details have not been given. So you have not been given the percentage shareholding and all that. And even the associate financials are not given, but we know that there's an associate. Right? Okay. So this is critical information for us to now analyze the pre-scene in relation to the consolidation. Right, this is what it is in one diagram. ELP holds how much? 26% ownership in OSL. Right, that was acquired sometimes back. Right. Also, Ajanta, he is an executive director of ELP, has how much? 24% shares in OSL. Okay. So In addition to that, OSL has an executive director. Roshan is actually a non-executive director of OSL. Who is Roshan? Roshan is the chairman of ELP. Now, having this investment of 26% in OSL, ELP would have given a chance to appoint a one board member. What they did was they have appointed their chairman, Roshan, as a non-executive director of OSL. So, which means ELP has the possibility of appointing one board member. So, having the opportunity to appoint a one board member means what? ELP can involve in the policy making decisions of OSL. You have a representation of the board means you can involve in the what? Policy making decisions. Right? That is also supported by the shareholding. Normally having 20% to 50% ownership of a company, we believe that investor is given a significant influence over the investee. In this case, at the moment, ELP consider OSL as an associate. That is given, that is reflected in the financial statements as well. That's correct. But the trick here is, remember, OSL, if you look at the shareholders of OSL, Ajanta, he is an executive director of ELP, has what? Significant holding, 24% holding in OSL. Are we clear? Then, in the pre-scene, it was clear OSL also has an associate, but the percentage is not given. But I'm taking a percentage as an assumption for you to explain the things. So if it is given in the unseen, this would be a different percentage, right? I'm assuming, let's say OSL has 30% shares in this particular associate. So OSL has the significant influence over this associate. So the OSL would become the investor, associate become the investee. OSL follow the what? If it is an associate, what is the accounting treatment? Special kind of a accounting treatment called equity accounting. Right? When you have an associate, the accounting is covered by LKS 28, investment in associates and joint ventures. Remember, associate is not a part of the group. Group is parent and subsidiaries. But associate is a special kind of an investment. As it is a special kind of an investment, you follow a special kind of an accounting treatment called what? Equity accounting. Right? Okay, so before moving to the possible scenarios, I told you this standard is important. LKS 28, very important standard. Okay, you should know A to Z of LKS 28 this time. Based on the information given, there are two associates, couple of associates. So I believe, right, this associate would be converted into a subsidiary in the unseen. Let's look at that. Before moving there, so associate is what? Associate is an investment where you have the significant influence over that particular investee. Normally, when you have a representation in the board, you have the significant influence. Now, what do you mean by significant influence? You can't control, but you can participate for the policy making decisions of the investee, right? You can't control, but you can participate. As I said, when you have a representation in the board, so you can participate for the policy making decisions so that you believe that you have a significant influence. And when it comes to shareholding, normally 20 to 50% range would believe that you have the significant influence over the investee. But having 20 to 50% is not sufficient because there can be situations where you are holding more than 20%, less than 50%, more than 20, less than 50. But still, if the examiner says that you don't have the significant influence, irrespective of the percentage holding, then you can't consider that as an associate. So the point what I wanted to mention is what is important is whether the significant influence is there or not. Whether the investor can participate the policy making decisions of the investee. Okay. So sometimes, even though you have, let's say, 25% in a particular investment, you still might conclude that you don't have a significant influence if you can't participate the policy making decisions. On the other hand, there can be situations where you have less than 20%. Let's say you have 18%, but still you conclude that you have the significant influence over the investee, especially if you can appoint a board member of the investee. Then you can participate the policy making decisions irrespective of the shareholding percentage. So it can be concluded as an associate, right? It's a judgment. Then if you have an associate, what is the accounting treatment that you need to follow? Equity accounting, right? What do you mean by equity accounting? In the statement of financial position, how do you account at equity accounting? If it's an associate, you take the initial cost plus share of post-acquisition net asset changes of the associate. You take your initial cost plus what? Post-acquisition net asset changes of the associate, you take your share. Let's assume if you have investment in an associate 26%. So the cost is the amount what you pay initially. Then from the date of getting the significant influence to the reporting date, what is the change in the net assets of the associate? Out of that, you take your share 26%. Right? That is in the statement of financial position. Statement of profit and loss, what do you have with regard to the associate? I explained earlier as well. So you look at the associate's financial statement. Out of that, you take your share of profit. In my example, 26% of profit after tax of the associate. You take into the investor's profit and loss statement. One line item saying share of associate profit after tax. Before the profit before tax, you have to show that. Similarly, if associate has other comprehensive income items, out of that, you have to take your share of. In my example, 26% of other comprehensive income of the associate. Again, one line item under the other comprehensive income of the investor. Right? Always with regard to the equity accounting, one line item in the balance sheet saying investment in associate under the non-current assets. Then one line item in the P&L as well as one line item in the OCI. Share of associate profit after tax and share of associate other comprehensive income. So that is equity accounting. Right. So now by keeping the preceding information in mind, let's read this information. This is yet again directly extracted from the preceding. And based on this, let's decide what is there in the examiner's mind. How is his mind is working based on the information what is there in this preceding. What it says? Roshan, he is the chairman of ELP. So an opportunity to excel his ambition to add new ventures and accelerate the growth of ELP by acquiring significant stake in OSL. That has already been done. Ajanta was involved in this negotiation and helped ELP to acquire 26%. ELP acquired 26% of the shares of OSL in 2021. That is back in 2021. This transaction has been happened. That is already there in the preceding. Just after the end of the COVID-19 pandemic. Roshan foresaw a future demand for ocean freight due to the high air freight rates and the shortfall of the aircraft, which were severely affected by pandemic worldwide. Now, Roshan predict the future. He foresee that there will be a good demand for the ocean freight rather than the air freight because aircraft or the air freight rates are very expensive and there's a shortfall in the aircraft. So he believed that this ocean freight business will grow in the future. Remember OSL in that business, no? Okay, what is the business of OSL? We looked at earlier. Non-vessel operating common carrier. So they are mainly into the what? Sea freight. Right? So which indicates that Roshan might be interested to acquire further shares in OSL. Okay? Right. What else? You have been given some more information that also supports our view. What is that? However, okay, this is separate part of the preceding, right? So another para of the preceding directly taken. However, OSL's performance turned out to be poor. We looked at no OSL's performance are not that great, making losses, right? Turned out to be poor, and Roshan was not happy with his investment. Now, because why? ELP has invested what percentage in OSL? 26%. ELP invested 26% in OSL. Now, Roshan being the chairman of ELP, he is not happy about this investment because OSL is making losses. Not happy with his investment. Since he was only a non-executive director. Now, Roshan is only a what? Non-executive director of OSL. He could only question and suggest and did not have the right to be involved in the day-to-day operation. That's correct, no? Now, it was mentioned earlier, Roshan is a non-executive director of OSL. Being a non-executive director, he can't get involved in the day-to-day operations. Day-to-day operations are managed by the executive directors. What he can do is he can give his suggestions at the board meetings, right? So that means you can't do much. Yes, you can participate for the policy making decisions, but you don't have the control over the day-to-day operations, right? Then 4 family members equally own 50% of OSL. We looked at. So the 4 family members equally own 12.5% each. 4 people own 50% of OSL, and 2 of them had a conflict with other 2 brothers about the performance of the company. Obvious. Now, there are 4 brothers. So out of that, 2 people are not happy about the performance of the company because company is making losses. They were willing to sell their shares to whom? Right. This is the point. They were willing to sell their shares to Roshan if he offered a good price. So now you can predict one scenario of the unseen. Roshan might acquire, right, shareholding of these 2 people, right? Actually, not Roshan directly there, through ELP, because ELP holds 26% of OSL. ELP holds how much? 26% of shares in OSL. Now, what happened is 2 people are not happy. These 2 people are holding how much? 25%. 1%, 12.5% into 2, 25%. That 25% stake can be acquired by whom? ELP. Right? That can be acquired by ELP. Then, although OSL is currently performing poorly, if managed properly, it can be turned around as the future of the non-vessel operating common carrier industry is bright. Okay, Roshan believe that, okay, this can be turned around. Company can be turned around. So, now this is the pre-scene information. Yet again, what we discussed already. There's one more thing I want to tell you before I move on to the scenarios. I'll tell you what scenarios can be tested in the examination, different scenarios, right? Before looking at now already I explained the first scenario actually, but before moving there, if I ask you this question, right? If I ask you this question, tell me what percentage now ELP is holding 26% in OSL. That's clear, no? So which gives the significant influence over OSL. And so the ownership percentage is 26%. Ownership percentage is 26%. There's no doubt on that. But what do you say about the voting power of OSL? What do you say about the voting power of OSL? Remember this guy who Ajanta is a what? Executive director of ELP. That means Ajanta is paid by ELP. Right? Executive director means what? You are working for the company ELP. You are getting a salary from ELP. If ELP makes any decision about OSL, do you think that Ajanta will go against that? No. So most probably, but actually it is almost certain where Ajanta would support for any decision made by ELP in terms of OSL. So actually, if you look at the situation, voting power of OSL, ELP has voting power or the control over the voting of OSL up to what percentage? 50%. Why? 26% here, and also ELP can what? Get the Ajanta's voting powers as well, because Ajanta is working for ELP. So the control model, we learned there are situations where you don't need to have majority of voting rights. You don't need to have more than 50% ownership of an entity to say that I have the control over the other entity. You have to look at the other relationships of the investor. Now, in this case, what is the voting power? It is limited to 50%. 26 plus 24. But control means what? You have to have the voting power even with the relationship with the other parties. You need to have majority. Here you don't have a majority, right? You just have only 50%. So how many more shares that ELP needs to acquire in OSL to get the majority of the voting rights? With the support of Ajanta, 1 share is enough. If ELP acquire additional share, 1 share, yes, even ELP acquire a insignificant percentage of shares, 1 share even in OSL, it seems that ELP has the what? Majority of the voting rights in OSL with the votes held by voting rights held by Ajanta. So still I have not looked at the scenario. This is what is given in the present, right? Hope this is understood. Then the rest we discuss. OSL is having an associate. Percentage is not given. I assume that is to be 30% for you to explain the things. Right. What is the first scenario? I already explained to you. So out of 4 brothers who holds 50% shares, 12.5% each, 2 are not happy about OSL's performance. They would sell their stake to, they actually are willing to sell their stake to, it mentioned as Roshan, that means most probably to ELP, if they get a good price. So the unseen can be what? In the unseen, the first scenario would be, examiner say, ELP will take the shareholdings of these 2 unhappy brothers by paying this much of premium over the fair value of the net assets. So then what you do? As we already discussed in many past papers, you need to calculate what is the net asset value, including the value adjustments that you need to make, and calculate the value of the net assets, right? Out of that, what is the value of that 25% of OSL? Then with the premium, how much of consideration that you need to pay, right? You have to calculate that. Ultimately, what will happen? So once ELP acquire another 25% in OSL, what will happen? Percentage holding of ELP will increase from 26% plus another 25%, 51%. That means even without the support of Ajanta, in that scenario, ELP is getting the what? Majority of the voting rights. Right? If you look at the scenario, this is what is going to happen. This is scenario 1. What is scenario 1? ELP will obtain the control over OSL. ELP is getting the control over OSL by acquiring 25% stake of 2 family members who are unhappy. So then what will the shareholding? ELP has 51% shares in OSL, right? Ajanta is also holding 24%, but that 24% is not required actually, because ELP now has what? Directly, by their own, majority of the voting rights in OSL. Then OSL has this associate. What is the relationship? Parent company, subsidiary, under the subsidiary, there's an associate. Right? So you have to apply the acquisition accounting for the subsidiary. That means you have to consolidate the subsidiary. You have to apply the equity accounting for the associate. right? So if this is the situation, what is the holding of the parent company? 51%. Now, once you establish the control, now for you to decide whether the control is there or not, now whether the ELP has the control in OSL, to decide whether the control is there or not, right? So for that, percentage might not be important. What does that mean is, sometimes, actually that is the second scenario where we'll discuss that in the second scenario in detail. Sometimes there can be a situation where ELP has less than 50% in OSL, but still you might conclude that ELP has control over OSL, right? That is the second scenario which we'll look at. So the point what I wanted to mention is, but these percentages, ownership percentage is important for you to do the computations. Because why? Now in this particular scenario, if ELP acquire 51% in OSL, what is the non-controlling interest percentage in OSL for the computations? For the computations, the percentages are important. What is the NCI percentage? 49%, right? This 24% is also considered to be an non-controlling interest when doing the computations, remember. Right? Percentages are important for you to do the computations. Computations are done based on the percentage. So if this is the scenario, purchase consideration paid by the parent company to acquire subsidiary is in relation to this 51%. Remaining 49%, including this 24% shares held by Ajanta, is considered to be the what? Non-controlling interest. Right? Then, if this becomes a subsidiary, so parent, subsidiary, this subsidiary has an associate, means in the consolidated financial statements of ELP, you have to equity account this associate. You have to equity account the associate. Right? We discussed about the equity accounting earlier. We discussed about the equity accounting. What is the equity accounting means? Now let's say ELP is preparing their consolidated P&L. If ELP is preparing their consolidated P&L, what you do? You have to take share of. Now in this particular situation, okay, so what is the percentage shares in terms of the, now I have assumed this as 30%. OSL is having 30% in this associate. What is the percentage holding in this associate? 30%. When ELP is preparing their consolidated statement of P&L, profit and loss statement, what you do? What you do? It is from the parent's point of view. You have to take this associate profit after tax figure. Out of that profit after tax figure, you have to take 30% and include that in the consolidated P&L. Similarly, you have to take this associates other comprehensive income. Out of that, take what? 30% and include that in the consolidated other comprehensive income. Remember, it is 30%. Don't take 51% into 30%, right? Don't do that. Take 30%. Thereafter, after you derive the group profit, now after including the share of profit after tax of the associate, you derive the group profit. Then once you derive the group profit, what you do? Thereafter, you would allocate that group profit into the owners of the parent and to the non-controlling interest. When you are doing that particular allocation, you should remember this profit after tax figure of the associate, you have taken 30% out of it. That is in relation to the subsidiary. Right? So when you are after deriving the group profit in the consolidated P&L, when you are allocating the group profit, what do? Parent's profit, entire thing is belongs to the parent company. Subsidiary profit, what do? You allocate part of it to the non-controlling interest, part of it to the owners of the parent. So when you are allocating the subsidiary profit, remember this share of profit after tax of the associate, what you have already taken to the consolidated P&L, will also be allocated to the non-controlling interest and to the owners of the parent. Right? You take the share of profit after tax figure of the associate, 30% to the consolidated P&L. Then when you are allocating the group profit, remember out of that figure, as per this question, how much of percentage you allocate to the NCI? 49% you need to allocate to the NCI. That is at the time of allocating the consolidated profit to the owners of the parent and to the NCA. Are we clear? I hope you understood. Right? Right? That is about the when you are preparing the consolidated P&L. Then on the other hand, let's assume that ELP is preparing the consolidated statement of financial position. ELP is preparing what? Consolidated statement of financial position. In that situation, what do you do with regard to the subsidiary? Consolidation, line by line addition. That's clear. No? And also, the investment that you make here, subsidiary make in an associate is an asset in the subsidiary's books. Right? This investment that subsidiary made in an associate is also an asset in the subsidiary's books. That is also getting added into the consolidated statement of financial position, right? Okay, the full amount of investment that OSL made in this particular associate is getting added to the consolidated statement of financial position. And then thereafter, in the consolidated statement of financial position, equity accounting means what? Cost. That is the cost of investment that OSL has made in this associate, cost plus share of post-acquisition net asset increase. Now, what you do is from the date where this particular investee would become an associate, from that date to the reporting date, you take the net asset increase. Out of that, you need to take what? 30%. That 30% you need to debit to the investment in associate account in the consolidated statement of financial position. Right? So basically, here in the consolidated statement of financial position, you have the investment made by subsidiary in associate, that plus 30% of net asset changes in this particular associate. It is debited to the investment in associate account. But the credit entry, you need to be careful. Where to credit? This is balance sheet, double entry. Debit entry goes to the investment in associate. The share of net asset increase, when you pass the credit entry, if you are preparing the statement of financial position, 51% goes to the what? Consolidated retained earnings, 49% goes to the non-controlling interest. Full amount is debited to the investment in associate account, right? 30% increase in the net asset of the associate. Out of that, 51% credited to the consolidated retained earnings, 49% credited to the non-controlling interest, right? So that is the structure what we have in this particular question. So that is the, what you say is the most complex scenario that can be tested in the exam, but I don't think that examiner, even if examiner goes up to that level, I explain to you how to account for that. But I don't think that will be a complex scenario like that. Okay. So most probably what will happen is examiner would give you unseen information where assume these transactions are taken at the reporting date. So to reflect you how the consolidated statement of financial position would look like. Then you don't need to be worried about, what will happen to the share of profit after tax, share of other comprehensive income, share of post-acquisition net asset increases might not be applicable, but even if we test, now you know what to do. Right? If you don't understand what I say, what you do is watch this particular lecture again, because this is really, really important, and try to understand. Okay. Right, that is the first scenario that can be tested in the exam. Again, let's move to the beginning, because these 4 scenarios what I'm going to give you is independent to each other. Right. First scenario is this. Now clear up your mind again. Go back to the original scenario. What is given in the pre-scene? Okay. There are certain questions in the chat box. I will answer that in a little while. So the answers for those questions are there in the PowerPoint presentation itself. Right. So clear your mind. what is the original scenario? ELP has 26% investment in OSL. And OSL has assumed 30% investment in this associate. And I explained to you, even though ELP has 26% ownership in OSL, if you look at the voting power with the support of Ajanta, ELP has 50% voting rights of OSL. So that even a small percentage acquisition would give ELP the control over OSL. Because why? Ownership can be less than 50%, but by looking at the control model, which I will discuss in a little while, so by looking at the other factors, if ELP has the majority of the voting rights, or if ELP has the power to govern the relevant activities of OSL, ELP controls OSL. What can be the scenario that can be given in the exam? If examiner wants to, to be a little tricky without directly giving this scenario, he would tell you, right? Now there are two people who are unhappy, who holds 12.5% each, altogether 25%. So examiner might say that out of those two people, ELP approached a particular person and negotiated a particular transaction price. So yet again, how to calculate the transaction price, examiner will give you the information. So he would say that this percentage of premium over the fair value of the net assets of OSL. Yet again, you need to calculate what is the net asset value, including the fair value adjustments or whatever the adjustments, right? Then take 12.5% out of that, including the premium. This is the amount that you're going to pay. Right? In this situation, if you acquire the shareholding of only one person, this 26% would become what? This plus 12.5%. How much? 26 plus 12.5, 38.5. Now tell me. Then this is the scenario. Right? Everything else is same. Only difference is what? Now 26% would become 38.5%. Now tell me. Does ELP has the control over OSL? What do you say? Now you should be able to answer, because we have a very good foundation to answer. Yes or no? Even though the ownership is less than 50%, when it comes to voting rights of ELP, Ajanta is a executive director of ELP, so that Ajanta would agree on what ELP decides. So including this 24%, even though you have less than 50% of ownership, you have what? Majority of the voting rights. So when you add together 24 and 38.5, how much? 62.5% voting rights, but the ownership is 38.5. But what matters in the control model? Control power. Here, ELP has the power to direct the relevant activities of OSL. So ELP has to consolidate OSL. Parent-subsidiary relationship is created. The rest of it, as we described in the scenario 1. Then OSL has the associate. I assume that this is 30%. Then the equity accounting, whatever the principles that I discussed, is applicable to this scenario as well. But you need to be careful when preparing the consolidated financial statements here, because why? In this case, tell me what is the non-controlling interest of OSL. Now we decided ELP has the control over OSL. OSL has an associate. Here, ELP has the control over OSL, means parent-subsidiary relationship is there. So ELP can prepare the consolidated financial statements. What I'm asking is, in this scenario, what is the percentage of non-controlling interest? Because these percentages are important for you to do the computation. For the goodwill computation, NCI computations. So these percentages are important. Tell me, what is the NCI percentage here? When it comes to NCI percentage, 100 minus 38.8, how much? 61.5 is the NCI percentage. For all the computations, you have to take 61.5% of NCI. Okay, you decide ELP controls OSL. Thereafter, When it comes to computation, look at the ownership percentage. Right? That is the tricky. That's why I said that this is a bit of a tricky question. And these type of scenarios have been tested in the past as well. Right? Even in recent exams, there were scenarios. You are consolidating a subsidiary where your ownership is less than 50%. So if your ownership is less than 50%, your NCI percentage holding is more than 50%. That's fine. Apply the normal rules. Okay. Right. So the rest of it is same, right? What I explained in scenario 1 can be applicable for scenario 2 as well, other than this particular change. And even examiner might say, without telling you acquire 12.5, ELP acquire, let's say, this is the normal scenario, this is the original scenario, no? Let's say ELP acquired 5%. Then what will happen? This percentage will increase to how much? Forget about these two people who wants to sell. So ELP can acquire 5%. Somebody outside, or even out of these, one of these two people, you acquire only 5%. What do you say? Does ELP has the control over OSL? Yes. Why? 26% plus 5, 31%. Ownership is 31%. But the voting rights, 31 plus 24. 31 plus 24, how much? 55% of voting rights. ELP controls OSL. Right? That's why I said that this is a bit of a tricky question. Understand that. Okay. I hope scenario 1 and scenario 2 are well understood. And what's going to be tested in the exam is out of these two. One out of these two. Right? Because in the recent exams, examiner is maintaining the relationship between the pre-seen and the unseen. Sometimes back, it was totally different. What is there in pre-seen? Something else, something different in the unseen. But that trend has been changed. That's a good thing. Where examiner is maintaining the consistency of the information what is present in the pre-seen and unseen. So by reading the information, you understood, right? Where it's going to be ELP to take the control over OSL. Roshan wants to get involved more in OSL and turn around the company in the way of making money. Right? But you never know, no? If examiner's mind has been changed. Okay, so before moving there, I discussed about the control model. Before moving to the scenario 3 and 4, I discussed about the control model. There are 3 elements in terms of the control. So for a particular investor to say that you have the control over an investee, investor should have the power. Power means what? Ability to direct the relevant activities of the investee. What do you mean by relevant activities? Activities which significantly affects the investee's return. So power means what? Ability to direct the relevant activities. Relevant activities means what? Activities that significantly affect the investee's return, like manufacturing decisions, selling and distribution decisions, capital structure decisions. So if investor has the ability to direct those activities of the investee, we say that what? Investor has the power over the investee. Then investor expose the variable returns of the involvement of the investee. That means if investee does well, return of the investor increases. If investee makes money, profits, so the return of the investor goes up. If investee make losses, the return of the investor is coming down. Okay, so that is what is meant by expose the variable returns with the involvement of the investee. It's not a fixed return. If investee does well, that is good for the investor. If investee doesn't do well, that's not good for the investor. The third point says that investor has the ability to affect those returns by using the power. Power over the investee, then expose the variable return. Then by using that power, investor can affect the returns. How does the investor do that? Investor appoints the board of directors of the investee. Investor appoints the senior management people of the investee. By appointing the senior management people, what investor does is investor affects the returns of the investee. So these are the three, conditions or three elements of satisfying the control. Then I explain about this slide. Then this is the most important thing. I'm not going to go through each and every one, but I, insist you to go through this list. So we discussed when you are discussing theory sessions. Now, the most important thing here is actually in this control definition, whether the investor has power over the investee, right? Now, normally the normal situation is if investor has more than 50% of the ownership of the investee, then investor has the power over the investee. But we came across situations where sometimes investor has what? Less than 50% of ownership over the investee, but still exercise the power. So I already explained to you with the involvement of Ajanta, how ELP takes or ELP derives the power over the other company, right? We already explained, right? If I go back, so we discussed ELP can exercise the control. ELP has the power over OSL, even without a scenario of what? Even without a scenario of, in this scenario, second scenario, ELP doesn't have the majority of ownership, but still ELP has the what? Control over OSL because of the relationship that ELP has with Ajanta, right? So basically these are the scenarios, these are the examples where you don't have the 50% of the ownership of a particular entity, but still by looking at these factors, you might decide a particular investor has the power over the investee. If investor has the power over the investee, you can conclude that by using the control model, investor controls investee, then investor would become the parent, investor would become the subsidiary. The fact that we looked at in this list is, this is the particular point that we looked at in this scenario, Ajanta's involvement. What is that? Nature of investors' relationship with other parties. Here, who is the investor? ELP. Nature of ELP's relationship with whom? Ajanta, other parties. That may enable the investor to exercise control over an investee. Okay, so finally, what is the conclusion? It is therefore possible to own less than 50% of voting power of an entity, but still exercise the power over it. That is scenario 2 in our predictions, right? If I am the examiner, that is the scenario that I'm going to give you, right? So you can really test the knowledge of the students, not only on the consultation, but also about this control model. Okay, that would be a very good question if that is tested. It would be a quality question if that is tested, right? But scenario 1 is also possible. If examiner doesn't want to put you all in trouble that much, he would test scenario 1, right? It doesn't mean that I want to put you in trouble, right? I'm, helping you to understand, okay, even if we test the worst case, you all are ready now, right? Okay, moving on. This is clear, no? Then scenario 1 and 2, what is the technical word? Even though we discussed about the consolidation, I have not discussed this technical word. Scenario 1 and 2, what is it? It is a what? Step back position, right? What do you mean by step back position? Investor obtains the control over investee in stages, not at once. Now, both scenario 1 and 2, we discussed ELP is taking the control over OSL. Is it at once? No. Because if I go back, this is the first block of share purchase, 26%. Once you purchase 26%, ELP doesn't have the control over OSL. But with the second block of share purchase, it can be 25% or it can be 12.5% or it can be even 5%. With the second block of share purchase, ELP exercise the control over OSL. So what is the step back position? So you should be thorough with, you should be familiar with, you must aware how to account or how to prepare the consolidated financial statements when you have a step acquisition scenario, right? Now, if you look at this second scenario, and let's try to apply step acquisition to that. Second scenario means 26% plus 12.5%. Okay. So what you do? You have to remeasure the previously held equity interest to the fair value. Now, what is the previously held equity interest? 26%. On the date where you purchase the second block of shares, what you need to do is up until that date, you have to account, ELP has to account the investment in OSL as an associate, no? Just 26%. On the date where you obtain the control by purchasing additional 12.5% shares, the previously held 26%, you need to measure it at fair value. Then you have to compare that fair value with the equity accounted value of that associate. You get the fair value of this 26%. Then you get up until that date, once you equity account, what is the value of the associate. So you compare these two, the difference you take to the profit and loss statement. So if you are preparing the consolidated statement of profit and loss, that difference, it can be a gain or it can be a loss, that has to be taken to the consolidated profit after consolidated P&L. It has to be taken to the consolidated P&L. Similarly, if you are preparing the balance sheet, that is taken to the consolidated retained earnings. Okay. Recognize any resulting gain or loss in P&L for the year. So thereafter, what you do is you need to calculate the goodwill and the non-controlling interest and the other consolidation workings. So this is the way that you do. Now, first of all, what you do, this is about the goodwill computation in a step equation, fair value of the previously held interest, which means previously held 26%, you fair value. Compare that with the equity accounted value of the associate, gain or loss, take to the consolidated profit and loss statement. If it is a balance sheet question, gain or loss to the consolidated retained earnings. Then fair value of the consideration for the additional interest. If it is scenario 2, to acquire additional 12.5%, how much parent company has paid? What is the consideration of that additional 12.5%? NCI at acquisition. Now in the second scenario, I told you what is the NCI percentage? What is the parent's ownership? For the computations, percentages are important. What is the parent's ownership? 26% plus 12.5, 38.5. So which means 100 minus 38.5%. How much? 61.5% is held by whom? NCI. Either you need to take the proportionate value of NCI, or else examiner will give you this is the value of NCI at acquisition. Because there are two methods to measure the NCI at acquisition. Value method or the proportionate net asset basis. Whatever the way, there has to be 61.5% NCI value at the rate of acquisition, you take it. Then add these three together, deduct the fair value after incorporating all the fair value adjustment, because when parent acquires subsidiary, you have to fair value all the identifiable assets and the liabilities of the acquired subsidiary. There can be fair value adjustments with regard to lands, right? Then there can be additional assets like subsidiary has a brand in their individual financial statements that has not been recognized. For the consolidation purpose, you have to recognize that. So then there are changes to the net asset. After incorporating all these adjustments, you take the value of the net asset of the subsidiary at acquisition. This minus this is the goodwill figure. On the other hand, in your non-controlling interest working, this is the opening figure. In your balance sheet, your non-controlling interest figure, actually the double entry is debit that figure to the goodwill computation, credit that figure to the non-controlling interest. That is your opening figure of the non-controlling interest working. Scenario 1 and 2, both are what? Step equations. That question has been asked in the chat box I saw. Now I have answered, right? As I said that to wait a while. Right. Okay. Other questions I'll take it at the end. Okay. Because without, then I can continue it without disturbing to the flow as well as without confusing the others. Right. Okay. Are we clear? Right. Then I told you, normally in the recent examinations, examiner, right, give a clear, so when he's testing the questions in the unseen, he continues what is there in the pre-seen. But sometimes back, couple of years back, actually, that was not there. You have something in the pre-seen, unseen, you have something totally different. Let's say, if that is the case, we should be ready, right? So yet again, refresh your mind. This is the original scenario. Always these four scenarios are independent scenarios to each other, right? So that's why I want you to refresh your mind. So this is the original structure. ELP has 26% in OSL. OSL has an associate. I assume that has to be 30%. Ajanta holds 24% in OSL. He is a executive director of ELP, right? At the moment, ELP equity account OSL. It's an associate. Okay. And OSL equity account, this particular associate. What can be given in the exam is, let's say ELP is not happy about the performance of OSL, as well as Roshan is not happy about the performance of OSL because he can do little because he is just a non-executive director of OSL. Being a non-executive director, you can't involve with the day-to-day operations. So if Roshan believes that no point of holding this investment, 26%, what he can do? He can dispose this, right? So he can dispose the entire 26%, right? Or else he can dispose part of it. Let's say 16% he dispose and he keep 10%. So that is your scenario 3 and 4, right? What is scenario 3? ELP will dispose the entire holding of OSL. So then what you do? Very simple. You have to calculate the disposal profit of the associate. You dispose your associate. What is the disposal profit? Take out the associate from the financial statement. We'll come to how the computation is done in a little while after explaining the scenario 4 as well. This is what entire disposal of an associate. Right? Scenario 4 is partial disposal of the associate. Yet again, original scenario. This is the original scenario. No? ELP holds 26% investment in OSL. What ELP can do? Dispose what? Part of it. Let's say 16% disposed. Then what is the remainder? 10%. ELP will dispose part of the holding of OSL, leaving it to a financial asset. Now, when you have 10% investment of another entity, that would become a financial asset to you. So once it would become a financial asset, what is the applicable standard? SLFRS 9. Financial asset. It is equity instrument, equity financial asset. So if it is an equity financial asset, you initially measure that at fair value. Initial measurement of this 10% has to be at fair value. Thereafter, you have to subsequently measure that under FVTPL, fair value through profit and loss, or fair value through other comprehensive income based on the measurement rules of SLFRS 9. I believe that you know the measurement rules of SLFRS 9. So the point here is, in this case, if this is the scenario, OSL, earlier it was an associate to ELP. Now you are losing the significant influence and you are just having 10% where ELP has a financial asset. It's just a normal financial asset, 10% holding, no significant influence. Here also, what can be the question to calculate the disposal profit? Right? In both these situations, how to calculate the disposal profit, I have included. So how to calculate the disposal profit? You have to take the disposal proceeds in scenario 3 and 4. 1 and 2 I already discussed. No? Scenario 3, if you look at scenario 3, disposal proceeds means what? You are disposing what? This is the scenario 3. No? You are disposing the what? Entire holding. Entire 26%. So you take the disposal proceeds of entire 26%. Fair value of the retained investment. In scenario 3, I don't have any retained interest because you dispose everything. You had 26%, you dispose entire thing. Nothing retained with you. Then carrying value of the associated disposal. So at the disposal date, what is the equity accounted value of the investment in associate? In your balance sheet, what is the equity accounted value of the associate? You take it here and deduct that and calculate the profit or loss on disposal. That profit or loss on disposal you include in the consolidated statement of profit and loss. If it is a balance sheet question, consolidated retained earnings. In scenario 4, this is scenario 3. Scenario 4, what will happen? You had 26%. How much you dispose? You dispose 16%. So what is the proceeds of that 16%? Then you have a retained interest of 10%. You fair value that. What is the fair value of that 10%? And that fair value would become the initial measurement as a financial asset because hereafter it's a equity financial asset. Okay. So you take the fair value of the 10%. So then yet again deduct the equity accounted value of the investment in associate at the rate of disposal. What is the equity accounted value? In the books, you deduct that, you calculate the profit or loss. It is taken to the consolidated P&L. If it is a balance sheet question, consolidated retained earnings. Are we clear? Are we clear? Okay, right. So I told you this time before you go to the exam, you must read LKS 28. In and out of LKS 28, you should be aware, right? So I have included one para. What is important is para number 10 of LKS 28 to explain how the accounting treatment is. So most of the things I have explained, except for a couple of things. So I'm not going to go through, you can read it. So I'll take those couple of things as well. I'll ask you the question. Let's say you have an associate. Now you know how to do the equity accounting. In P&L, in OCI, in balance sheet, you know. Let's say you receive dividend income from the associate. Now, for example, if I go back, this is the original scenario, no? Forget about all these other, pre-seen information analysis or anything. Just look at this. You have an associate, 26%. Right? OSL, let's assume, OSL distribute dividends. So when OSL distribute dividends, out of these dividends, you get 26%, no? ELP gets 26%. Even here, when this associate declare dividends, OSL gets how much? 30%. So what I'm asking, once you receive dividends from an associate, tell me the double entry. What's the double entry? Where to debit, where to credit? I'll tell the debit entry. You tell me the credit entry. Debit cash. Simple, no? Debit cash. Where to credit? Dividend received from the associate. The credit entry has to be passed to the investment in associate account. Don't credit that to the P&L. Because why? What is credited to the P&L is the share of associate profit after tax. Now, once associate declare dividends out of that profit, if you credit that dividends also to the P&L, what will happen? It will be double counting. Got it? What is taken to the P&L in terms of the associate is what? Share of associate profit after tax. The double entry of that is debit investment in associate account, credit consolidated P&L. When associate declare dividends and once you receive your portion out of it, you debit cash. If you credit that also to the console P&L, what will happen? Double counting. So actually, once associate declare dividends, what will happen? Associate's net assets value comes down. Associate declaring dividend means what? Net asset value of the associate is coming down. So net asset value of the associate comes down means your equity accounted value of the associate in the statement of financial position has to come down. Because I told you, what do you mean by the equity accounted value in the statement of financial position? Cost plus share of post-acquisition net asset changes. So once associate declare dividends, net assets of the associates comes down. So your portion of the dividends, what you receive, you debit cash and credit to the investment in associate account. Remember that. Okay, very simple, but you should understand the concept. That is the first thing what I want to tell you with regard to that particular para 10 of LKS 28. One more thing, that is, if you look at OSL, we looked at the financial statements. OSL is not making that much of money, right? Making losses. OSL is making what? Losses. Sorry, not, yeah, OSL is making losses. We looked at the financials now. If I quickly go up, here, OSL is making losses. Right? Because of that, if you go to the Ecom Logistics PLC financial statements, now ECL, sorry, ELP, Ecom Logistics PLC, ELP. If you look at the financial statements of ELP, so where you have 26% ownership in OSL, OSL is considered to be an associate, you have to take what? Share of associate profit after tax. Share of profit after tax of the associate, negative. Last year negative, this year also negative. As associate is making losses, if you look at the investment in associate, that is getting reduced in value. Right? So this can be considered as an impairment indicator. So the examiner would give you a scenario where the investment in associate in the books of ELP is getting impaired. So with regard to the impairment of associates, what is the applicable standard? General impairment of assets standard, LKS 36. You have to apply LKS 36. If you have impairment indicators, you have to check whether you need to book the impairment loss by comparing the carrying value with the recoverable value. If the recoverable value is less than the carrying value, you have to book the impairment loss. In the exam question, it would be very simple, right? Based on the numbers, you know what is the carrying value of your investment in associate in the statement of financial position. What is the carrying value? Examiner will give you, okay, this is the recoverable value of the investment in associate, or this is the market value of the investment in associate. If the recoverable value is less than the carrying value, what you need to do? You need to book an impairment loss, right? So the amount of the loss, what do? You credit the investment in associate account because value of the investment in associate account will come down. Credit investment in associate account. Debit entry goes to the consolidated P&L. Debit entry goes to the consolidated P&L. That would become a part of this share of profit after tax of the associate, because in the consolidated P&L you have anyway the share of profit after tax of the associate. No? If you have an impairment loss with regard to the associate, that also to be factored into this particular line item, because with regard to associate in the consolidated profit and loss statement, only one line item, share of profit after tax of the associate, which should include any impairment losses that is incurred in terms of the associate during the year. If it is a balance sheet question, what do? Double entry, credit the impairment loss into the investment in associate account credit. Debit entry goes to the consolidated retained earnings. Right? Okay. Every bit and pieces of LKS 28 I discussed. I don't think that anything else can be tested in the exam. We took a lot of time, a little more than I expected even, because these are really, really important in terms of the examination. Right. So this is actually para 10 of LKS 28. Everything I discussed, you just need to go through now. Okay. Right. With that, we are done with what? Consolidation. We are done with consolidation area. One more area. That won't take that much of time, but important because why? These are easy marks, right? These are easy marks because if you look at the recent examinations, always examiner is testing a question out of this. Analysis and interpretations, relatively these are easy marks. So because of that, we should get the full marks here, right? Okay. Yeah. Don't worry, I'll be sharing the presentation, right? So I'll share with CS Sri Lanka and they will share the presentation with you all, right? Don't worry. Right. Analysis and interpretation. There, this is actually from investor's perspective, right? So as an investor, you need to evaluate, analyze the financial performance, position of the company, mainly through the ratios, right? Mainly through the ratios when it comes to the exam scenario, right? So if you look at the analysis and interpretation, I'm not going to teach you all types of ratios that need to be aware, right? There are different categories, many categories of ratios, profitability ratios, liquid ratios, gearing ratios, market ratios, right? Working capital ratios, a lot. But if you look at past trend in the exam, examiner, I would say, allow to test this DuPont analysis. What do you mean by DuPont analysis? The main ratio relevant to the equity holders of your business is what? Return on equity. If you are an equity holder, you would definitely look at this ratio. How much of return that you generate for your investment. That is a return on equity ratio. Now, this return on equity always better to have a higher return on equity. That is the expectation of the investor. That is the expectation of the shareholder. Shareholders are the equity holders now. So we should aware this return on equity ratio is a combination of three things of the business. It is the combination of profitability, efficiency of utilizing your assets, and the gearing, leverage. So net profit. Now, what is the equation of calculating the return on equity? Forget about the DuPont analysis. What is the equation of calculating the return on equity? You take your net profit. This is how you calculate the return on equity. Divide by equity, no? Net profit divided by equity. Net profit means profit after tax. Now, this is a multiplication of what is the first ratio? Profitability. So profitability means more specifically, this is the net profit margin. This is what? NP margin. Net profit margin. So how to calculate the net profit margin? Net profit, profit after tax divided by revenue. Always having a higher net profit margin is better for the company. Then the second ratio is what? I'll write here. Asset utilization. That measures the what? Efficiency. Efficiency of utilizing the assets. So this ratio is asset turnover ratio. Asset turnover ratio. So the name of this ratio is asset turnover ratio. Revenue divided by total asset. That measures the efficiency of utilizing the asset. What is the meaning? For 1 rupee investment in assets, how much of revenue that the entity generates? Always better to have a higher ratio. For 1 rupee investment in asset, if you can generate more and more revenue, that is better. NP margin into asset turnover, profitability into efficiency. Into what? This is what? Leverage. And this ratio is called as what? Equity multiplier. Right? Total assets divided by equity. Assets divided by equity. This explains how much of your asset is funded by equity. The remainder of the assets are funded by debt. If you fund more and more assets by using debt, that means less equity, more debt. This ratio is high. Less equity, more debt. Ratio is high. Leverage is high. On the other hand, if you have more equity, less debt, this ratio is low. If you have more equity, you use equity to fund your assets most, then equity value is high. Ratio is what? Low. So basically, the argument is you can increase the return on equity by increasing the leverage. But you should understand, when you increase the leverage, financial risk of the business will also increase. What do you mean by financial risk? When you add more and more debt capital into the business, your fixed commitments are high. Now, if you fund your assets by using equity, if you earn profits, you can pay dividends. If you don't earn profit, you don't pay anything. Isn't it? If you fund your assets, fund your business by using equity, what you can do? If I make a profit, I pay dividends. If I don't make a profit, be silent. But can you do that with debt? If you fund your assets by using debt capital, you have a fixed commitment to pay interest. Whether you make a profit or not, you must pay interest. So that's why I say that increase in leverage increases the financial risk. Your fixed commitments are increasing. You should be aware about that. Okay, so basically, examiner wants you to break down the return on equity ratio into these 3 ratios: profitability, efficiency, and the leverage, and compare that with a benchmark. The benchmark can be the last year or else the industry. Okay, compare the breakdown of the 3 ratios with the last year numbers or with the industry numbers and comment on the performance. Very simple. So if you look at the past paper questions, in the recent past paper questions, you have questions of this nature. Okay, so yeah, you can easily explain. So this is the calculation, the analysis part. You have to explain whether you are better than the last year or whether you are worse than the last year, or whether you are better than the industry or whether you are worse than the industry. Sometimes what he would do is he would further break down this ratio. That is what? NP margin further. He would go one step below. So how can you break down this? This can be broken down into 3 more ratios. One is, this is net profit margin. No, you can say operating profit margin. Operating profit margin. How to calculate the operating profit margin? How to calculate that? PBIT, profit before interest and tax. Because interest is not your operation. Interest expenditure is not your operations. It is your capital structure. Take out that from operations. So because of that, you take profit before deducting the interest and taxes. Operating profit, PBIT, divided by revenue. That is your operating profit margin. Then the second one is interest burden. How much of interest burden there in the business? So how to calculate this? Profit before tax divided by profit before interest and taxes. Profit before tax divided by profit before interest and taxes. If the interest burden is high, listen carefully, if the interest burden is high, this ratio is low. Having a lower ratio means your interest burden is high. Right? And the third one is tax burden. Tax burden. How to calculate the tax burden? Profit after tax divided by profit before tax. Again, what is the meaning? How do you interpret this? If your burden, tax burden is high, this ratio is low. On the other hand, you are getting a lower figure for the ratio means your tax burden is what? High. Okay. So now when you set off, now what we did, net profit margin, net profit divided by revenue, I further split into 3. Now when I net off, what will happen? PBIT to PBIT will net off. Then PBT to PBT will net off. What is the remainder? PAT divided by revenue. That is what? Net profit margin, right? What is remaining ultimately? PAT divided by revenue. That is what? Net profit margin. On the other hand, when you look at the DuPont equation, the main equation, what is getting set off? Revenue to revenue set off. Total assets to total assets set off. What is remaining? Net profit divided by shareholders' equity. That is what? Return on equity. Right? Simple. So look at, couple of past papers, recent papers where you have these questions. Before you go, ensure that you know how to apply this DuPont model for the given financial statement. Normally, if the question is tested, what examiner would say is, without taking any of the information in the unseen or without adjusting anything what is given in the unseen, you do the computation based on the numbers given in the pre-seen. So because of that, look at the financial statements given in the pre-seen, right, with regard to the 2 companies and ensure that you can work out these numbers and you look at these, do these computations and ensure you are ready. If it is in the unseen, easy marks, calculation very simple, right? And even the analysis interpretation is not that difficult comparing the other questions. Right. Okay, so with that, we are done. I took more time than what I expected, but it's an in-depth analysis of your pre-seen. So most of these areas, what I discussed would be there in the examination, right? I looked at every possible thing in terms of the accounting standards, consolidation, as well as the ratio analysis. So finally, what I want to tell you is, don't be panicked. We know SL1, ABR is a bulky paper. So the content is huge, right? You have financial reporting, you have governance, you have ethics, risk management, non-financial reporting. I believe that you are thorough with these new standards, right? I'm not going to cover because Indunil has covered that area. Non-financial reporting, especially S1 and S2, introduced very recently by CS Sri Lanka. Sustainability related standard, where to identify sustainability related risk and opportunities. Then the climate related disclosures, you have to identify climate related risk and opportunities. Scope 1, 2, 3 emissions, right? A lot of concept, transitional provisions, then the concept of proportionality, right? All these areas are really important for the exam. So if you have missed that session, which was done by Indunil previous to, before I am, taking over, he has done a session, 1 hour session. If you missed that part, ensure that you watch that. That's going to be definitely tested in the examination. Right. So as mentioned, I will share the PowerPoint presentation with you. I hope the session was interesting. and it will be helpful, definitely helpful for you to successfully complete the examination. Hope to see you somewhere else, not in another pre-scene session, right? As a chartered accountant, I wish you all the best for the upcoming examination, right? And also, I would like to thank CS Sri Lanka for organizing this seminar series, where it would be definitely helpful for the students to successfully complete their examination. Right. Okay, so with that note, we'll make a conclusion. See you.